It's 9 a.m. here in New York City. I'm Shauna Smith alongside Diane King Hall. This is Yahoo Finance Live, and here's what we're watching on this Monday morning. Now, Black Friday for the ages. Online sales neared a record $10 billion to kick off a busy weekend of spending. That's according to the latest numbers from Adobe. Now, folks are still shopping, but holding out for deals. Can Cyber Monday keep this momentum going?
Beyond holiday shopping, investors are increasingly focused on the new year. Deutsche Bank out with bullish calls for the S&P 500's 2024 performance. But the year's not done yet. There's plenty of data on deck, including the Fed's favorite inflation measure.
And expectations that interest rates have peaked is lifting gold prices to a more than 6-month high this morning. Meanwhile, oil taking a dip amid uncertainty around more OPEC plus production cuts after this week's meeting was delayed.
All eyes are on Cyber Monday after record online Black Friday sales. According to Adobe Analytics, shoppers spent a record $9.8 billion online the day after Thanksgiving. But even amid the record sales, shoppers are putting off the bill a bit later. Buy now, pay later orders rose by a significant 72% compared to a week prior. And it's interesting to note, Shauna, when you look into that data, the rise of BNPL, that was something that really stood out to me in terms of the Adobe. So you had $79 million of that nearly $10 billion spent on putting off the bill until later. So, you know, the deals are causing people to say, you know what, I want it now, even if it means incurring more debt. And it's a huge increase when you compare it to last year, up 47% from a year ago.
Yeah, exactly, Diane. We know we've been talking about for so long the weakening overall economic picture, exactly consumers pulling back on their spending, being a bit more frugal in terms of what they are buying this holiday season. That has been reflected in the numbers here that we're getting from Adobe. I also want to bring up the move that we're seeing in Shopify this morning, because that's an outperformer ahead of Cyber Monday. The e-commerce demand here really helping the results that we've seen so far from Shopify. The company saying that merchants set a Black Friday record with a combined $4.1 billion in sales. The street very encouraged by this. Looking at some of the analyst commentary reaction here to these early numbers, Morgan Stanley's Keith Weiss saying that Black Friday sales suggest upside to investor expectations. He sees Q4 gross merchandise value, GMV growth in the high teens on a year-over-year basis. We know Cyber Monday is going to help paint a more complete picture in terms of that consumer demand and exactly what people are spending on and what that appetite is to spend now, given the fact that maybe these retailers will continue further discounting some of those items as we get closer to the holiday. And like you said, Cyber Monday is expected to be the biggest online shopping day of the year. Record $12 billion is expected. That would be up just about 5.5% from the levels that we saw about a year ago. But let's talk a little bit more about those promotions, because discounts and sales, they're in focus as retailers try everything they can to get shoppers to spend. Here with a closer look is our very own Brooke DePalma. And Brooke, I think all shoppers out there are asking themselves how this year's promotions stack up to what we saw last year. What are you seeing?
Yeah, well, consumers certainly, as I said on Wednesday before this cyber weekend, they need to know their prices, because what we're seeing is these big box and these apparel retailers really come out and say that we have the biggest deal yet. But actually, some of them are in line with last year, more than last year, and some discounts even less year over year. Some retailers that got a call out in notes so far, Jeffrey saying that Abercrombie Fitch is a clear winner here. Now, it's important to note here is that last year they had 30% off. This year, 25% off. But what we've seen in the recent earnings reports is that consumers continue to go to Abercrombie. They continue to shop there. And so despite that 5% discount that's less than last year, consumers are still expected to shop there. Another one that we are keeping a close eye on is recreation, the leisure category. We're thinking Yeti, Academy, Dick's Sporting Goods. Jeffrey's analyst saying that despite promos being flat year over year, these sort of retailers continue to do well in a more promotional environment. Another one to look out here is Gap. The analyst there said that they're in the early innings of what they said was a turnaround. Now, what's interesting, once again, is that year over year, the promotions are flat. And at Old Navy, those promotions even decrease, but that is one to watch. Urban Outfitters also increased their promotions, but their one brand, Anthropologie, was flat over a year. And one other thing that I've continued to see is that beauty remains a resilient category. Yeah. Piper Sandler shouting out e.l.f., Coty, and IPAR, Inter Perfumes, that is. prices, we continue to see these splurging among consumers as they stock up on beauty. They continue to do those day-to-day purchases, those lotions, the mascara, those little daily use products continue to do well in this sort of environment, and they certainly did well this weekend.
Kind of like brings back memories of the lipstick indicator. I mean, people will still splurge on their beauty products even when their wallets are tightening. But interestingly enough, now when you think about both how we've talked about how much consumers have become reliant on their credit cards, despite tightening credit environment, but now using more the BNPL way of checking off their list. Another thing that stood out to me was I saw some data showing that the average discount this year was about 35%. And so you're seeing some variance to your point about where that discount is. So some places it's marginally lower than it was a year ago. Some places it's a little higher, but then you get to the average. But another interesting pattern that I saw this year, and we've talked about this for years on end, is this overtaking of the online footprint, clicks versus bricks, right? And even when we saw the images from Sazi being out at the mall on Friday, it was less foot traffic than we've seen in previous years, and you can see it by the numbers. Even when you think about what the expectation for the numbers today, we're expecting $12 billion for Cyber Monday. That would outstrip the record number for Black Friday.
Yeah, this is certainly not your 2013 Black Friday anymore, sadly, although that was fun while it lasted. Definitely something to watch out for, too, is the timeline between Thanksgiving and Christmas this year. Christmas does fall on a Monday. A lot of analysts expect shoppers to wait till that last weekend to get the best bang for their buck, to get the best prices for their last minute Christmas shopping. And so really this period of what is 32 days does provide a longer timeline for shoppers to get their shopping done. And once again, they're waiting for the right price and the right quality item.
They certainly are. All right, Brooke, thanks so much. Well, you were just talking about some of the outperformance that we've seen recently in some of the beauty stocks. We want to call attention to Ulta this morning because this is one name that the street is worried about, at least when it comes to one outlet here from Citibank. Well, shrink headwinds and an uncertain holiday season could cause some issues for the company. This is all according to Citigroup. Analysts at the bank opening a 30-day negative catalyst watch on Ulta shares and cutting the price target on the stock by $35 a share. This is all on expectations that the company is going to miss Wall Street expectations later on this week. Now, this call comes despite strong demand for cosmetics and what has been a relatively good year for Ulta. The retail reporter reporting consecutive solid quarters of beats and raises, but with inflation still historically high and clear signs that consumers are finally feeling the pressure, Wall Street is starting to question Ulta's ability to deliver this time around. When you take a look at the stock year to date, it's actually been under some pressure here, off just about to 12% over the last month, though. We have seen some excitement surrounding the name, with shares up just about 9%. In terms of what Citi is taking issue with, we mentioned the fact that they do see the company missing the street's expectations. We'll hear from Ulta later this week. Higher promotions weighing on margins, ongoing shrink headwinds being a big issue for the company. That's something that we've seen across the retail landscape. Most recently, they also see management lowering their fiscal 2023 guidance. So whether or not consumers are still willing to spend on some of those beauty items that they had been pretty resilient on up until this point, that's a big question for the street up until this point and then going forward into 2024.
Right. To your point, the shrink remains an issue for brand like Ulta. And with their Q3 results expected to be weak, I mean, they've even called that out on their last earnings call, kind of cautioning that EPS would be and kind of expecting it to be a high single-digit percentage. Their CFO talked about that, and that their third quarter operating margin would be more pressured than what it saw in the second quarter. So, one of the things they're dealing with is also pricing pressure, right? They don't have the pricing power that they had previously. So that's a challenge when you think about Ulta, especially when you compare it to other brands that it's competing with, right? So they would have to be dealing with this landscape of consumers being more choosy with how and where they spend their dollars and other headwinds, as you mentioned.
Yeah, and it's also to point out that there's still a handful of analysts that are bullish on this name. Cowen's Oliver Chen was out naming it a top pick here for Black Friday. He's saying that Ulta continues to outperform outperform on strength in beauty and fragrance. When you take a look at the recent retail sales numbers that we got from October, he pointed to the fact that we did see a jump in health and wellness spending. So he still views Ulta as a winner this holiday season. So some conflicting views on this name as we approach a very important next couple of weeks into the holiday. And then, of course, look ahead to some of those 2024 spending trends.
Right. Another company we're watching, Citigroup, also downgrading Foot Locker this morning to a sell rating from neutral. Now, analysts warning that the company will end the year in a difficult position and pointing to weaker web traffic and credit card data as reasons behind the downgrade. This is the second big bank in a row to turn cautious on Foot Locker. Now, last week, BTIG lowered its rating to neutral from buy, warning macro and competitive headwinds are going to keep Foot Locker's outlook in check. And I feel like we've been talking about Foot Locker all year with regard to kind of concerns about its performance and where it stands. Foot Locker was one of the companies that also, when you think about the weakness even from Nike and, Nike pulling back on inventory there. And Foot Locker, if I recall correctly, there was an issue with shrink there as well. So you have these elevated inventory levels that are really causing a problem for Foot Locker. Could cause it to have a more promotional environment as it continues through the holiday season versus just this weekend. Of course, all the retailers are doing a heavy promotional environment through today, right? Or even through this week, Cyber Week, right? But beyond this week, Foot Locker may have to continue to rely on that. Hence, Citigroup's call on Foot Locker.
Yeah, the street's been waiting for this turnaround to really take shape now for quite some time. It's been a name that's been under pressure since really the start of the year and really going back even before that. You mentioned Nike there. I want to bring up just in terms of how important Nike is to Foot Locker specifically. It accounts for about 64% of sales come from Nike products. So that in itself really proves, and Citi pointed this out in their note this morning, that Foot Locker is not completely in control of what is ahead, not completely in control of their own destiny. To putting it in Citi's words here from this note, you mentioned the fact that we could see some more pressure here on gross margins, weaker gross margins going forward. Elevated inventory levels has been a problem for Foot Locker and so many of their rivals here coming out of the pandemic. Citi taking the angle that they think they are going to be even more reliant on some of that promotional activity this holiday season to get rid and clear some of that backlog that they have been dealing with now for quite some time. They see Foot Locker sacrificing some of their margins in the near term through the end of the year to better position the company ahead to 2024. But Foot Locker really has its work cut out for them. We've been talking about the fact that they need to execute on this turnaround plan, the fact that consumers are pulling back on spending right now, a pretty challenging setup heading into 2024 could prove that a turnaround like this that we've been waiting for from Foot Locker could take maybe a bit more time than we had initially expected. All right, let's take a look at shares of Chinese tech company Tencent getting a little bit of a boost today on news that its rival ByteDance is cutting hundreds of jobs in its gaming division. Now, this is a major blow to the TikTok owner, but it could be viewed as a win here for Tencent. We're looking at gains of just about 0.5%. Here with a deeper dive into these names is our very own Ines Ferre. And Ines, when you take a look at this report here coming out from ByteDance, I mean, this is a bit of a turnaround because we know that they had been focusing on building up their gaming division, trying to challenge what Tencent has been very successful at.
Yeah, that's right. They had been investing quite a bit of money in their gaming division, which had started back in 2019. It's called Nuverse. And then during the pandemic in 2021, ByteDance said that its gaming unit would be one of the pillars for ByteDance. So this is significant, the scale back that the company is taking. ByteDance is going to be cutting jobs from its gaming unit. It won't completely shut it down, but it will be significantly scaled back. And it's unlikely that it'll enter back into this industry. So just to take a step back, the gaming industry really boomed during the pandemic. The global video gaming market, it's a $185 billion industry. In China, it's dominated by the likes of Tencent, which you mentioned that today is up, also NetEase. But ByteDance was not really able to, despite its efforts, to gain a lot of market share from Tencent. In recent years, it had bought back in 2021 for $4 billion. It bought the big gaming studio Moonton. And of course, ByteDance is known for TikTok, that's what they're very well known for. But as far as what the gaming industry is concerned, it wasn't able to really ever make money from gaming, turn some of its successes in gaming into a commercial success. The industry is also notoriously fickle, but this is a big win for Tencent. It's a big win because Tencent is the leader in the sphere. It has been among the Chinese companies. It owns WeChat, and Tencent has a really large library of titles. It has developed its own. It's also acquired its own. But a significant move within the gaming industry, the fact that ByteDance is stepping back.
All right, indeed, a win for Tencent. And Naz Foray, thanks for the deep dive.
Thank you.
Meantime, gold rising to a 6-month high today, driven by a weaker dollar and bets on a conclusion to U.S. interest rate hikes. Yahoo Finance's Jared Blickery has the details. Jared?
Hey guys, what a morning. Let's see if we can find gold on my leaderboard here. We've seen some movement pressing above $2,000 for, I don't know, is it the 5th time, the 6th time? But nevertheless, it's been pressing up against that level. Here's what it looks like over a 3-year time frame. And you would say correctly, well, this is simply a sideways market and it happens to be at the very upper end of this range. Let me show you a 5-year and you can see a little bit different story. It's simply been flagging here at elevated levels for some time, and maybe the 20-year gives another added dimension here. We've come up to about the 1800 level. That was what, 2012, 2013 in there, and then we've had this very, very long consolidation near the highs. Now, one of the things I want to point out, we have a lot of buyers of gold, not the least of which is retail, but let me show you what central banks have been doing. Going back to 2010, this shows you how many tons they've been buying each year. This is last year. This was 2022, and that was that horrible year for the markets. That's when we saw interest rates shooting up. Nevertheless, central banks wanted to own gold, and I think that says a lot about the yellow metal. You'll notice that this line, this bar for 2023 is a bit shorter than this one. This is only through the 3rd quarter, so this could very well conceivably add considerable height to this into the end of the year. We'll see if we can eclipse that 1,000 ton mark. Let's get a check of the other indices going on today. Let's take a look, for instance, at the S&P 500 futures, Nasdaq as well. As I navigate down here, there we go. We can see that the, there we go, S&P 500 futures, and it takes, we spent most of the morning here since about 12 p.m. Midnight in red territory, but you take a look at what happened last week. This is a 5-day look. We did have kind of a nice rally. The indices posted about 1% on. And also I should point out that, as I've been pointing out, this is the most bullish time of year. This 3-month period right here, especially considering Thanksgiving into the end of the year, which is a Santa Claus rally. So there's lots of expectations, and a lot of investors are playing catch up here. You got to imagine if you're a portfolio manager on Wall Street and you are so far underperforming the market this year, the way most hedge funds are, there's going to be a game of catch up into year end. And I think that's what we're seeing here with the breadth of the rally, just kind of taking everything up with it. And even meme stocks, guys. You thought meme stocks were done? Wait until the end of the year here, 2023. There you go.
It's a bit of a worrisome sign. But again, we've been talking about this FOMO rally, the FOMO trade, at least right now, in terms of portfolio managers doing everything they can to catch up to some of that outperformance that we've been seeing, specifically in those tech names leading up to the final weeks of the year. Jared, thank you. Well, a ceasefire between Israel and Hamas that began on Friday is holding this morning. Militants released 17 more hostages on Sunday, including 14 Israelis and an American citizen. Israel itself released 39 Palestinians. Now, it was the 3rd exchange during the 4-day truce. A 4th exchange is expected today. For more on this story, we're joined by Yahoo Finance's Rick Newman. And Rick, when you look at reports here, I guess up until this point, that negotiations are still continuing over a possible extension that we could see to the ceasefire.
Yeah, and I think a lot of people didn't think we would even get this far, Shauna. So the original plan was 4 rounds of hostage releases on both sides. And we've gotten through 3, so 39 Israeli hostages released by Hamas so far, and 117 Palestinians Israel has released. And we're trying to get to round 4 here. There are holdups over what they say are the names on the list, which is exactly who is going to be released. And then there seems to be a different set of problems, even locating some of these hostages that Hamas snatched when they went into Israel on October 7th. Hamas says they don't even have all of those hostages. Other groups have some of them, and they don't even know where they are. So I think what's interesting about this is there is a little bit of momentum here for continuing this pause in the fighting. And I think people on both sides would like to see this go on indefinitely. Now, Prime Minister Netanyahu of Israel, he is saying, no, this is not an indefinite pause. We're going to resume this war. We need to eliminate Hamas. But I think it's fair to say encouraging that we've gotten as far as we have.
Rick, that's a great point. When you talk about this, the situation there with the ceasefire happening right now and the pause, do we think, and I've heard chatter this weekend about, is there the possibility for this being extended, or is this really just a moment by moment? We'll continue to watch this throughout the week or days.
My guess is it's moment by moment. I don't see how Netanyahu can, having said the point of this war, of this invasion into Gaza, the point is to eliminate Hamas. I don't see how Netanyahu, who is already in all kinds of political trouble in Israel, I don't see how he can sort of do an about face and then say, well, we're just going to maybe just call it off. I just don't see how that's going to happen. And we are going to reach an end point here when there aren't going to be any more hostages that Hamas is willing to release, because they are saying it is possible that there are almost something like 185, 187 other hostages not included in this agreement of the 50. And Hamas is saying, well, maybe there are a few elderly men we could release, but as for all the others who are basically prime-age men, they're not going to release them. So that seems to be the end of the line, and that is where this war seems likely to resume. But in the meanwhile, another important thing is happening, which is aid is getting into Gaza. So food and fuel and stuff that's desperately needed by people who are obviously living in distress in Gaza. So the more that can get in, the better. But this doesn't seem like it's going to last that much longer.
All right. Well, there are some promising things that we saw this weekend, and it's good to hear about the food and fuel getting in. Rick Newman, thank you so much.
Bye, guys.
All right. We've got more of your markets action ahead. Stay tuned. You're watching Yahoo Finance. New bulls have entered the ring. Both BMO Capital Markets and Deutsche Bank out this morning with calls for the S&P 500 to end 2024 at 5,100. Deutsche Bank strategists say they expect earnings growth to stay resilient and offset a, quote, mild short U.S. recession. Deutsche Bank's call comes after RBC Capital and Bank of America last week both predicted the index would hit 5,000 in the new year. Amid these bullish calls, what's on deck for the market into year end? What should investors consider for 2024? Joining us now is Chris Versace, Tematica Research Chief Investment Officer. Chris, thanks so much for joining us as usual. So let's talk about your expectations for 2024, and especially when you think about these calls. What's the outlook that you have?
Well, I have to say those outlooks are, they're very bullish, and I think we'd all love to see them happen. The big question to me really underpins earnings growth for next year. You take a look at the S&P 500, it's been flat pretty much this year, and the consensus expectation is earnings have to grow, more than 11%, call it, 245 a share in 2024. And then you have to take a look at the multiple that we're going to place on that from a PE perspective to hit that 5,000, 5,100 range. They're very, very lofty compared to where we've seen the S&P 500 tend to peak out, around 2,000 to just last year. The average PE high is around 19 times. So I don't want to be a Debbie Downer for the viewers out there, but those numbers could be a little lofty even if the Fed begins to cut rates at the middle of the year.
So Chris, if those numbers are a little bit lofty to you, I guess what is your more realistic, to put it in your words, I guess, outlook from here till the end of 2024?
So I think we're going to probably be, if we hit, 4,600, come back in December and then rally towards the end of the year, which is the growing narrative for the market. I think we're going to continue to move higher, call it that 4,800 level. But again, it's really going to hinge on where we see that EPS growth for 2024. If we do see a slower economy in the first half of the year, some people call for a recession. We're going to see earnings power dip in the first half of the year. So there's a lot of expectation, therefore, being put on the back half of the year. Rates will be lower. We have an election year. There's a lot of reasons to get very bullish about the second half of 2024, but we're going to need to navigate that first half.
And Chris, we're kind of in a sleepy time of year when it comes to data, but we've got a key data point coming in the week ahead, right? We've got the Fed's key inflation gauge that we're watching for. What are you looking to see?
We're looking for continued progress, down in the data. But, candidly, the more important data is going to be the November CPI report that we get right before the Fed's December meeting. And all indications are between the continued fall in energy prices, used car prices, and even what we saw on the intermediate October PPI data is that the November CPI data should continue to show further progress on inflation. I think that's going to cement the view that the Fed is done hiking rates. And of course, that means we're all going to be discussing when the Fed is likely to begin cutting rates.
So, Chris, you mentioned there just a moment ago that we're going to have to figure out how to navigate the first half, especially when you talk about all of that uncertainty. So what should investors be doing today to better position their portfolios for that?
So what we're doing over at the Action Alerts Plus portfolio is we're taking stock of what the consensus expectation numbers are. We're lining up where we're seeing not only lower inflation, but in some respects, deflation. We're taking a look at the shape of the consumer, as we learned over the weekend, a lot more gravitating towards deals, buy now, pay later. So we're trying to pick our spots. And I think that's key to point out because most investors don't, quote, buy the market. Right? You can use SPY or some market ETF if you want to do that, but most people like to pick individual stocks or have targeted exposure. So you've got to really, roll up your sleeves, check the thesis, look for companies that are poised to grow their earnings faster than the market. You'll get multiple expansion. That's a great way to sharpen your pencil for 2024. All
right, Chris Versace, great stuff there. Tematica Research Chief Investment Officer. Thanks so much.
Thank you.
We want to get over to the opening bell on Wall Street. Let's do a quick check of the markets. We're seeing stocks take a bit of a breather here this morning following what has been a pretty astounding rally over the last several weeks. Jared Blickery is standing by with a closer look at some of the movement that we're seeing. Jared.
That's right, Shauna. Things quieted down last week, and I think we're seeing a bit of a continuation of that today. We have a mixed market, but a whole lot of nothing going on. S&P 500 down only about 7 basis points. Here's the 5-day price action. This takes us back and shows us last Monday, only 4 days in that prior week, but we can see still maintaining gains of about 1% here in the S&P 500. And we'll just check out the Nasdaq, which has been the story of the year. About the same, though, not quite as high on its price range. And then just taking a look at the small caps as well. Those have bounced back recently, but really just flat to sideways price action over the last 5 days. Let's take a look inside the market. And sector-wise, I've been tracking the sectors since the beginning of last week. Today, it's consumer discretionary and tech. Those are the only ones in the green. But if you take a look at the last 5 trading days, going back to last week, it's healthcare. That's XLV. That's in the forefront, followed by communication services, staples, and then looks like tech, not quite outperforming there. So interesting, slightly defensive look at the sectors. I'm just kind of commenting the way Wall Street might be seeing things right now. And then if we take a look at our leaders here, this is over the last 5 days. Meme stocks have picked up, defense stocks, but let me drill this down and show you guys what's happening today. Same leader there, meme stocks up about 0.5%. To the downside, though, and we have more losers than winners. KWEB, that's a Chinese internet ETF, it's down about 1.5%. Bitcoin also down a similar amount, as is cannabis and solar energy for that matter. Let's take a look inside the Nasdaq 100 and get a view of what's going on here. Mega caps more green than red, but not any big outperformers. Amazon just barely getting 1% in the early going here. To the downside, looks like Pinduoduo is down 1.68%. I was flagging just a moment ago the weakness in Chinese stocks. And taking a look inside of tech, I'm going to take a look at software and chip stocks. Software have actually done a bit better over the last week, although just about everything has done fairly well over the last week. So here's a look. Shopify up 2%, but not really any other standout outperformers or underperformers. Semiconductors, a different look here, just keeping within the underperformance relatives to software that we've seen recently. Just about everything here on the board is red. And I do want to take a look at the travel sector. We are coming off of a near record, if not record, travel holiday season for a lot of people here, and kind of a mixed board. Looks like Marriott is up 16 basis points, Carnival Cruise Line's up 31 basis points, but the airlines seem to be mostly in the red here. United down about 0.7%, and I'll just pull up the 1-year chart here before I toss it back to you guys. And well, not too bullish there, but down 11% for the years, guys.
All right, Jared, thanks so much. We're going to get to our market commentary of the day, and it has been a year of major indexes leaning heavily on just a few big stocks. No doubt that you'll have heard all about the Magnificent Seven. Now, Apollo's Torsten Slok weighing into that conversation this morning. He says that the divergence between the S&P 7, which is the Magnificent Seven, and the S&P 493, the rest of the stocks in the S&P 500 continues, and also points out that investors buying the S&P 500 today are buying 7 companies that are already up just about 80% this year. He does go on to compare the valuations right now of that S&P 7, the Magnificent 7, saying that they're beginning to look similar to the Nifty 50, which is back in 1972, also to the tech bubble back in March of 2000. We've been talking about the outperformance of the Magnificent 7, obviously since the start of the year, but drilling down into why they have had such an outsized impact on the performance of the stock. The combined companies have about a weighting of 28% in the S&P 500. So the outperformance has certainly dominated the performance of the broader index. You point to the fact that a lot of this has been fueled by the AI rally. Torsten Slok titling his note this morning that AI is the latest shiny new toy. So, of course, the question is what the performance looks like of these tech stocks going into the new year. We know that we have heard a bit of diverging views in terms of whether or not there's still upside momentum left to some of these names. Goldman's David Kostin, who has a S&P target of just around 4,700, so limited upside from current levels. He does see some of that outperformance next year being led by the mega cap group. And he points out the fact that they've had faster than expected sales growth, higher margins, a greater reinvestment ratio, and also stronger balance sheets that's going to help maintain some of that growth in the year ahead.
That's one of the things that stood out to me, and especially when we think about NVIDIA being a big part of that Magnificent Seven. You know, there were some questions going into its results about how well they would perform. Would they continue to beat? They handily did once again with their latest earnings report. I mean, that stock is up more than 200% year to date. I mean, far outstripping all the rest of the players in the Magnificent Seven, but each of those is up more than 50%, and that's on the low end. You know, when you think about Apple, that's up more than 50%. Microsoft up more than 50% year to date. Meta up 170% year to date. Alphabet also up more than 50%. Tesla more than 100% higher this year. Amazon up more than 70%. So they all have performed well this year, but again, that question remains of can they continue that performance into the year? And that note stood out to me as well with regard to Goldman's thoughts on the mega cap tech stocks that we've been watching, this Magnificent Seven. NVIDIA, clearly that has been far and away the leader when it comes to this AI play. So there's been a lot of support around its strength and it continuing to remain an outperformer because of how far they are ahead compared to competitors, Shauna.
Yeah, certainly. That is the case. And we've seen that play out over the last several months. So, of course, the question, I think, though, is what exactly that upside looks like. Yes, Goldman does see tech leading, but they also just have an S&P target of 4,700, which is pretty limited upside to where we are today. So we have to, I think, keep in mind that some of the gains aren't going to look anything like the gains that we saw this year.
This is true, and it's a little bit of divergence from these new bullish calls that we've been talking about today, this 5,100 target that we're seeing from Deutsche Bank, et cetera. We want to look at some other individual tickers that we're watching today. RBC upgrading Mondelez to outperform from sector perform. The RBC analyst calling the Toblerone maker best in class while citing category growth, share gains, a retail footprint expansion, and the increasing of shelf space at stores. Analysts also boosting its price target to 83, up from 75. So, you know, you want to keep in mind, though, how we talked about just divergence and how people, or how these analysts look at different stocks. So this is counter to Morgan Stanley, which lowered its price target on Mondelez, though not too far away from where it's upgrading it. They've lowered their price target to 74, so they have a little bit of a lukewarm opinion on Mondelez compared to where RBC is placing the snack maker now. Shauna.
Yeah, the analyst Nick Modi, he's a friend of the program, has joined us many times talking about the fact that this is a best-in-class growth profile. A lot of that coming down to the volume growth that we're expected to see here within Mondelez. It's one of the few consumer staple companies, like he points out here, that is expected to deliver on volume growth this year. You mentioned the fact that he raised his price target $83, so some upside here. You can see on your screen some upside to where it's trading today, just around $71 a share. They did reduce their rating earlier this year. A lot of that was about the concerns that we saw play out in the broader industry when you come to the weight loss drugs, Ozempic, what exactly that's going to do to a number of these consumer staples names, especially on the heels of some of the commentary that we got out from Walmart executives, some of the other companies saying that, hey, we exactly don't know what the broader impact is going to be down the line when more and more Americans start taking some of these diet drugs. Of course, the question is just what exactly that uptake looks like. So taking a look at this call here, at least Nick Modi's making the case that this is best in class, and he sees some potential to grow from the current levels. And this is a stock that really hasn't done much over the last 6 months, pretty much essentially flat over the last 6 months.
To your point, recently the CEO was saying not seeing much impact at this point from the GLP-1 drug. So it echoed similar comments from Nestle top brass as well. So that remains to be seen if it will hit that company's waistline.
Yeah, exactly. Because the question is what that uptake's going to look like 6 months, 12 months from now. All right, let's take a look at Novo Nordisk, because shares have been rising all year because investors are optimistic about the company's weight loss drugs. But is the hype overblown? That's what an investment director at GAM Investments is saying, cutting his stake in Novo Nordisk by about half over the last couple of months. Now, the director is saying that there are not strong competitors to both Novo Nordisk and Eli Lilly, but at some point, the patents for the drugs are going to run out. So this is all about the gains that we have seen since over the last several months, the hype surrounding this drug and exactly what the returns could look like here on out. Because of that, he is reducing his position within the pharma giant. Gallagher saying in a recent interview that we've been bullish on them for quite a while, but now there's a lot of hype and it goes beyond just the stock markets. You can open a Sunday newspaper without reading about their wonder drug. So a lot of that, he's saying, has already been priced into the name. And we have to mention that Novo Nordisk, because of this frenzy around Wegovy, turned Novo into Europe's most valuable company. And I think that pretty much sums up all the excitement that we've talked about with this name.
Indeed. And it's to your point, though, just about pricing. There's a piece in the Financial Times today about Novo Nordisk and its pricing deals for Wegovy. Though the company is not saying anything about necessarily cutting the price, the CEO saying is willing to be flexible on pricing in order to kind of spread out the cost of the drug. And, you know, they're not necessarily planning to cut pricing despite there's competition looming from, say, Eli Lilly, et cetera. But they're trying to see how can they handle and spread out these contracts that they have with big healthcare providers. Could they spread it out over a longer period of time, for instance, et cetera. So they're kind of trialing this data to see how this works in terms of pricing. So it's something that could be in, you know, something that to be thought about with regard to Novo Nordisk and Wegovy pricing.
All right, well, UBS upgrading Teva to buy from neutral and raising its price target in the stock to $13. That's up from $10 a share. Analysts there saying that they are revising the pharma company's outlook estimates, upping its sales compound annual growth rate for the next 3 years to 3 to 4% growth. UBS saying that the pharmaceutical company is, quote, uniquely positioned and is becoming more brand focused, which could drive the stock's outperformance in the years to come. I think that last line there, the focus on the brand performance, is really what sticks out to me within this report when you compare it to what has really driven the stock lately, or the focal point, I should say, from investors. A lot of that has been surrounded by revenue and EBITDA stabilization. So now we have this focal point transitioning to Teva's attractive brand assets, what exactly that's going to do for future growth. UBS obviously thinking that it's enough here to upgrade this name.
Yeah, and to your point, another thing to watch with regard to Teva, some clinical trials that it has going on. They're expected to finish the outcome of those in 2024 in the second half, and so that could help the company's brand pipeline. And certainly, could it add something with regard to the share price, because it's only up 3% year to date. So it's definitely one to watch when you think about that. And with that price target increase, it has more room to run. I mean, it's nearing $10 a share today. So we'll see if it hits that price target of $13 a share. What UBS sees. All right, we've got more of your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Oil prices are falling for the fourth trading day in a row following OPEC's decision to delay its key meeting on supply policy to November 30th. Now, this decision coming as members remain divided over quotas. The group is widely expected to tighten the market amid the weakness that we have seen in prices. Brent now sitting just below $80 a barrel. You can see it there, right above $80 a barrel on your screen. That's down nearly for a fifth day from its high, down nearly a fifth, from its high in September. For more on that, we want to bring in Claudio Galimberti. He's Rystad Energy's Senior Vice President and also head of Americas. Claudio, it's good to speak with you here. So when we talk about some of the pressure that we've seen more broadly on crude, on Brent prices over recent weeks, what do you think this signals in terms of the likely decision that we're going to get from OPEC Plus?
Thank you very much for having me back. It's one of the hardest decisions for OPEC right now. Reason being, the market is not as tight as it has been in the past 3-4 months. Especially if I look at the balances, so how supply and demand are basically playing out in the first quarter of next year. It does look like we are having higher supply than previously anticipated. So the decision here by OPEC and by Saudi Arabia will be whether or not to extend the cuts, which seems to be a very likely decision, and on top of that, whether to or not to make further cuts. So the fact that it is a hard decision is that this is on top of many cuts that have been implemented in the course of 2023. So it's going to be a very, very interesting meeting on Thursday.
So, Claudio, there have been reports, there's a Reuters report saying that the reason behind rescheduling was due to some African countries pushing for a higher output allowance. And they were given lower allowances this summer. What do you make of that?
It's true. So you have for sure Angola and Nigeria asking for more. They are ready to produce more. These are the countries that back a year and a half ago struggled to meet their production targets. Right now there is the opposite situation. This is more difficult to accommodate, right? For sure, if you're trying to constrain supply. There are also, very important, the United States has grown more than we thought until a few weeks ago. So the production in the United States right now is being revised upwards. Let's not forget that OPEC, for the past 3 years, OPEC Plus has found not such a strong, let's call it, let's use this term, opponent from the United States. The United States production has been growing. But in the course of 2023, it grew by 1 million barrels per day. It's a lot. So there is this push from the West African countries. There are also forces outside of OPEC that are making the decision very difficult for OPEC. So they would need to look at what's happening outside of OPEC. The United States will be number one. The production in the United States in 2023 has been very, very strong. It's probably not going to be as strong in 2024, but still growing. So the moment OPEC extend the cuts and also potentially deepen the cuts, they are effectively making room for other producers to fill the gap.
So, Claudia, what does that then potentially mean for prices if we do see them not only extend but further reduce some of that production, OPEC plus? Obviously, the U.S. will be left to make up some of that production. Will it be enough? And if not, how much higher do you see crude prices growing?
So I think that excellent question. Very difficult to answer, but our view is that if there are extension of the cuts, we're probably not going to see much price movement. Those have been highly priced in, highly anticipated and priced in at these points. So what we're really looking at right now is whether there's going to be further deepening on the cuts. So potentially Saudi Arabia cutting 300,000-400,000 barrels per day more, followed by potentially some cuts in Russia. If that is the case, then we should see a jump in the price. Probably not towards 100, but definitely towards $85-$90 per barrel.
All right. Well,
either is disagreement, and that's not something that can be ruled out at this point. Then this will be a recipe for a significant price decrease. So all options, in my view, are still on the table for Thursday. I would say that the most likely option at this point is that they extend, and on top of that, they do some additional cuts. because the first quarter is looking loose. Loose means that in jargon, it means that the supply of crude is sitting above the demand of crude, which means that the prices would correct downwards.
All right, all options on the table. We'll certainly be watching that meeting later this week. Thank you so much for joining us this morning. Claudio Galimberti, Rystad Energy Senior Vice President and Head of Americas. Claudia, thank you. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Cybersecurity is advancing at the speed of AI, with automation revolutionizing digital protection. Companies are now racing to stay one step ahead of cyber threats. The winners and losers of the market moving forward could be determined by who's future-proofing their cybersecurity systems. Lots of development in cybersecurity, but these are the three biggest changes in the space. First, we have automated cybersecurity. Companies can now use AI to quickly detect and respond to hacks. Microsoft just launched Security Copilot. That's an AI-powered cybersecurity assistant. But humans still have to use the technology correctly and prompt it for responses. So the next development, autonomous security systems that can make decisions without human help and therefore respond to attacks even if humans aren't available. As AI gets better, it'll also improve at predicting threats before they happen, again, without any human input. And this could save money for companies, especially as they struggle to source cybersecurity talent amongst us humans. Speaking of us, the password that we think of now is going to be a relic of the past. In the future, AI-powered biometric authentication will be the norm, meaning you'll take a selfie or scan your thumb instead of typing in a password. And this is part of what's called zero trust policies and the widespread adoption of that. It means what it sounds like here. Even if you're an employee, the company's not going to trust you, meaning even Mark Zuckerberg will need to go through several forms of verification before he can access Meta's network. Now, let's talk about regulation. As of September, the Securities and Exchange Commission requires public companies to do three things. 1, perform cybersecurity risk management programs. 2, to publicly disclose their processes for assessing cyber threats. And 3, publicly disclose any data breaches or attacks. Now, that last one could have a huge effect on the stock price of any impacted company. And the assumption here, the next big cyber regulation from the SEC will come for registered investment advisors. There's already a proposal in place to require all market entities to review and assess their cybersecurity protections. And this means professional investors would also have legally mandated cybersecurity requirements. So what can consumers and investors be preparing for in terms of what's next for cybersecurity? Joining us to discuss is Fatima Boolani, co-head of U.S. Software Equity Research at Citi. We also have Shailesh Rao. He's the president of Cortex. That's the cybersecurity arm of Palo Alto Networks. Thank you both so much for joining us. We really appreciate it. Shailesh, I'm going to start with you because you're leading this cybersecurity arm at one of the biggest cyber firms in the world. Talk to me about what's next for you all. What is the next big innovation that your team is coming up with to meet cybersecurity concerns?
Thank you, Madison. Good afternoon. Great to be here. Look, we are seeing a huge increase in cyber criminals taking advantage of the latest technologies that are out there, the same technologies that are available to us and available to every other company out there, whether it's AI or machine learning. And they're taking advantage of these technologies to try to, breach and hack into companies and ransom them, et cetera. So our focus as a leading cybersecurity vendor is to make sure that we take advantage of these technologies and we always stay ahead of the curve. As long as we're ahead of the attackers, we have an advantage and we can protect companies and governments worldwide. And that's been our focus.
And Fatima, I know your focus is in sort of sussing out which firms are most well-suited to meet some of those concerns. Talk to me about the public company names that you have a buy rating on right now. I know you've got a couple. Talk me through some.
Absolutely. So thematically within cybersecurity, to peel off a lot of what Shailesh was talking about, the names that we have been talking a lot about to our institutional clients are Palo Alto Networks, Fortinet, Zscaler, CrowdStrike, and CyberArk, which is a sub-$10 billion market cap company. All of these names do have very strong tie-ins to exactly, some of the themes that you laid out in your opening remarks.
And Fatima, staying with you here, those are your public company stock picks within the cybersecurity space. What about some wild card investments, some public companies that are impacted by the cyber world, but aren't necessarily cybersecurity focused firms?
It's an important question, Madison. I'm glad you asked. So while I wouldn't quite frame it as wild card, what I can share with you is there are certainly names in our coverage universe that I would characterize as unconventional plays on the cybersecurity theme and assets that are exposed to all the pain points that organizations have to deal with as it relates to cybersecurity. And the names that come to mind here are Datadog, Dynatrace, and HashiCorp. Now, these, like I said, these companies are not traditionally defined as cybersecurity companies. In fact, they operate in the observability and DevOps realms. But each one of these companies has a part of their portfolio that's dedicated towards tamping down blind spots for organizations, specifically as it relates to developers who are building applications and building applications very quickly. I know you've all heard of the phrase move fast and break things. And when you do that, you are introducing a lot more risk into the organization. And these three assets that I just mentioned have parts of their portfolio that help organizations really add or manage their exposure from an application security standpoint to the risk that they might be unveiling to outside attackers and bad actors.
Fatima, we're going to come back to that, but Shailesh, I want to bring you back in here. Typically, when I have someone on from a company, I would ask you how you're differentiating from your competitors. But with a problem that is just so ever-changing, like cybersecurity, do your competitors in this space, even the public companies, sort of become your friends here?
There is a level of collaboration that has to happen in the cybersecurity industry, because at the end of the day, Madison, we're all dealing with the same bad actors on the other side. So to some extent, we're on the same sides of this battle. But I do believe that at the end of the day, companies that can leverage AI and machine learning, at least in this new world, are going to have an advantage. So we've been doing AI and machine learning for over 10 years. It's not new, even though a lot of people might think that it just became popular in November of 2022 with ChatGPT. The fact is, we've been using AI and machine learning. We now collect over 1 trillion bits of data at Palo Alto Networks every day. That means every day we detect 1.5 million brand new attacks that were not seen yesterday. I just want you to imagine the scale of that. That is a level of scale and precision that we believe nobody else can provide in the industry, and that's what we're focused on. Because at the end of the day, if we can protect companies against any known attack by looking at all the data available, and if we can reduce the mean time to detect, it's a very important metric in cybersecurity, that's the amount of time it takes to detect when there is an anomaly in your system. If I can bring that time down to seconds, the advantage that gives me in terms of taking countermeasures against the threat actor is just immense. So our focus is to protect everything we know of and reduce your mean time to detection for things that are brand new. That's what we're focused on.
So Fatima, I know you're familiar with Palo Alto's focus. You also cover CrowdStrike, some of these names we were talking about earlier, these public companies. Talk to me about what you would say is the single biggest factor determining what you think of as a healthy firm in the cybersecurity space. When you look at those public company names that you gave us for your top picks here, what is that biggest factor that you look at for them?
Madison, our stock selection framework as it relates to these very important themes in cybersecurity is grounded on three very key principles. Number one, we like names that have a dominant market leading position in their large core markets. Number two, we like companies who can draft off of their market leading position in their core market into adjacencies. And number three, we like companies that are able to do all of that, which is a lot, profitably. So we look for profitability, we look for free cash flow generation. And that essentially is sort of the construct we use when we think about stocks. But at a thematic level, what makes a lot of these assets that I talked about very exciting, it's the bigger picture themes around how complex organizations are with respect to their IT environment. By the way, how much more complex they are going to get with respect to how distributed the workforces are these days, and with respect to remote work, how distributed the entire IT organization is, whether you have data centers, whether you have cloud, and whether you have folks like developers who are building brand new applications and not necessarily going through IT. So I think to Shailesh's point, reducing mean time to remediation and detection is great. And you absolutely need tools to do that quickly, because you have an attack surface for an organization that's growing so large. And so a lot of that, the stock picks that we have and stocks that we're very bullish on tend to have a wide enough portfolio to be able to address a lot of those pain points by way of a multi-product portfolio.
That quick detection is critical here. Shailesh, I'm curious what your thoughts are about the timeline for AI being able to fully autonomously detect those threats. If you had to put a time on it, when will we start seeing cybersecurity firms offering AI that can do all of this on its own?
Well, I have wonderful news for you, Madison. We're already doing that today at Palo Alto Networks. Within the Cortex portfolio, we launched a product called XIM, which is our most recent product. And we talked about it at our last earnings call as well. We are seeing mean time to detect go down from, in some cases, weeks down to seconds. And we're able to automate the detection of at least everything that is known almost instantly, thanks to using machine learning based on, using it on infrastructure that's custom and purpose-built for machine learning. So this is the state of the art. In fact, if companies are relying on humans to do this work, we think they're already at a significant advantage. So with things like XIM, you're able to get your detection as automatically done as is possible with the state of the art. And I'll tell you why that is important. Unit 42 from Palo Alto Networks, which is our incident response and research arm, we do thousands of cases every year of companies that get breached and then they call us.
Right.
In the cases that we work on, we've seen over the last 2 years, the average dwell time, which is the time that a threat actor or a hacker comes in, stays inside your network and leaves. That has gone down from 44 days down to 5.5 days.
Wow.
Now, you mentioned earlier about the SEC regulation requiring companies having to disclose upon a material breach. If your mean time to detect is greater than 4 days, you're done. That means every time something happens, you have no choice but to disclose, because you were not able to detect it within 4 days. So that level of technology is already here, and we're very happy that we're taking a leading position on that.
All right, we'll have to bring you both back on to talk about that in the next 6 months here. Fatima Boolani with Citi and Shailesh Rao joining us with Cortex, part of Palo Alto. Really appreciate you both coming on. Thank you so much.
Thank you very much. Wish you all a wonderful day. Bye-bye.
It's been a tumultuous time for the AI space with Sam Altman's abrupt ouster from OpenAI and now reinstatement. The company's much anticipated share sale is reportedly set to go on as planned this week and is expected to value the company at $86 billion. But as the dust settles, what's next for OpenAI and its fast-growing generative AI tool ChatGPT? Glenn Anderson, Rainmaker Group Holdings managing partner, joins us now. Glenn, thanks so much for joining us this morning. So let's talk about where this. Thank you so much. So where does this leave us now? What is investor sentiment like?
Well, look, Rainmaker's broker-deal that trades in almost 1,000 private stocks. So we get a pretty informed picture of the market, including that for OpenAI. And I'll tell you, the buy OpenAI at any price bid is gone. Sentiment has changed. Investors have more cautious and pragmatic approach to the stock now, and I think that's a good thing. Look, OpenAI might be the first company to come up with a genuinely useful generative AI product, but tech is littered with cases of first movers that losing in the long run. I mean, think Google supplanting Yahoo, Amazon outrunning eBay, and Facebook usurping MySpace. I mean, there are other options to play AI in the market. I can't pitch any particular stock, but we've seen sizable investor interest, for example, in Anthropic, Cohere, Databricks, and others. The point is there's multiple ways to play AI. I mean, with Sam coming back, OpenAI may resurge, but investors shouldn't fall in love with one stock, particularly now that we've seen the risks in doing so.
Glenn, from your past experience here, just in terms of when investors have lost some of their confidence in past companies, comparing that to what we've seen with OpenAI, what does OpenAI need to do maybe to regain that lost investor confidence? And you mentioned the fact of OpenAI's future and just questioning, I guess, where exactly they will stand in the larger generative AI race. Do you think that maybe they won't be able to regain any of that lost momentum?
Well, look, I mean, Sam coming back is great for the story. When he left, investors started running for the hills. I mean, we had over the last several months, we've had tremendous demand for OpenAI from investors. And when Sam was shown the door, investors pulled their bids. Now we're seeing some interest come back, but it's still early to tell whether we have enough confidence for investors for the stock to recover in the private markets. And as far as the $86 billion valuation, I mean, there is a question whether they can achieve that now. I mean, investors are rightly more cautious now and understand that there's risks in this story. It's not all, yes, it's the leader in the space, but every stock has risks, and OpenAI has risks, and investors are starting to recognize that. So, as far as them achieving an $86 billion valuation, I think the jury's still out on that question.
So, Glenn, then is it foolish for OpenAI to proceed with this previously planned share sale at this point?
I'm sorry, repeat the question?
Is it foolish then for OpenAI to proceed with this share sale? So should they postpone it?
Oh, foolish, yes. I don't know about foolish. This is the opportunity to test the market. And like I said, with Sam coming back, I think investor confidence is returning. And look, whether it's 86 billion or 75 billion or 70 billion, there's still the most valuable AI stock in the private universe. The only one close is Databricks, and where we're seeing Databricks trade is around 40 billion. So look, I mean, I don't think it's foolish. They're testing the market, but they do have to give investors more confidence now that we've seen the risks happen to this stock.
Glenn, would you put Sam Altman in the same space as like a Steve Jobs, who this happened to before?
I mean, time will tell. Steve Jobs is a hard mark to, but look, the guy clearly did a fantastic job at OpenAI. He's clearly a visionary. And look, I firmly believe that AI is the most important innovation in generation, and it will touch everyone on the planet. There's real risk to the technology, and so we need to manage that. But, Sam is, Sam's a visionary and a groundbreaker. Will he be remembered as a Steve Jobs? I don't know, but certainly he's a visionary entrepreneur.
Certainly is a visionary. I think everyone can agree on that. Well, Glenn Anderson, great to get your perspective. Rainmaker Group Holdings managing partner. Thanks so much, Glenn.
Thank you.
Well, we got a couple of bullish calls out this morning. Both BMO Capital Markets and Deutsche Bank out with their new calls for the S&P 500 for 2024. They both see the S&P 500 reaching record highs of 5,100 by next year. And now here with a breakdown of this recent sentiment, we have our very own Josh Schaefer. Josh, you and I were going back and forth on these calls here from the street. And I want to start with what we heard from BMO Capital Markets, Brian Belsky there leading this call. And what stuck out to me, and you I think as well, is the call that he has for earnings growth next year and exactly where he sees EPS. He has the S&P 500 EPS target of 250. What's the rationale behind that?
250 is the highest we've seen among these different calls so far. You know, Deutsche Bank actually has a $250 call too, which I didn't notice when we were talking earlier this morning and I was going back through the notes. They're both at 250, but as you can see on your screen, significantly higher than where a lot of the other banks are. And basically, I mean, this is a conversation that's been ongoing about, that quote unquote earnings recession being over, earnings having we've seen the peak declines there and sort of rebounding, overall feeling better about the economy and the way companies have positioned themselves. And then that sort of leads us to the price target and sort of what Brian Belsky is overall saying here when he says normal for longer, he thinks about a 20 PE on the S&P is fair. And so a 20 PE on the S&P brings you to about 5,100 based on his earnings call, and 20 is obviously a little bit higher than maybe the average, closer down to 16. So he's saying, we think we're in this stage now where normal for longer, well, the second year of a bull market is about 11% in the S&P is the upside we'd see. That's what he's calling for. So he's sort of saying we're back to just buy the S&P 500 and things might be okay and you're going to go up 11%, which I thought was interesting. Mm-hmm. I think my biggest takeaway, though, from this note and starting to think about what we're hearing in 2024, it's kind of okay to be a bull again, right?
It certainly seems like that.
I was reading through Belsky's note last year. Belsky's always bullish. We always call Belsky bullish. You can go back 10 years and read Brian Belsky calling it a secular bull market. Last year, he had the S&P about flat from his 2022 target. A lot of talk about recession, little bit of anxiousness about what was going to happen. He basically makes out the case here, if there is a recession, it's going to be okay because we've talked about it so much. And Deutsche Bank said the same thing too. That recession that we're talking about now is shallow. In general, strategists aren't that scared of the 2024 recession the same way they were scared of the call for a recession in 2023, and that's starting to stick out to me from these notes.
Yeah, I think that stands out as well. And when you think about, so last week was a holiday shortened week, but are we kind of back to reality this week in terms of data, company reports that we're watching? What are you looking for in this week ahead,
Yeah,
Josh?
Diane, there's certainly more things to watch this week, and as we were just sort of talking about when we think about this week and what it could mean for the end of the year, we're kind of in that, we're talking about the soft landing, right? And if we're still going to be on pace for that. So the key thing you're probably looking at this week is that Thursday data release of PCE, specifically core PCE. We know that's the Fed's preferred inflation measure. We want to see core PCE coming down, of course, in the same way that we saw CPI coming down. We're at the point now where that CPI measurement from October pretty much priced out rate hikes, any more rate hikes, and it now has people talking a lot more about when rate cuts are going to happen. Be interesting to see if rate cuts move at all this week with the PCE. Do we see that move up a little bit? We've seen a couple quick moves to March in those markets that we know are very volatile, but does that actually stick this week if you get a good core PCE number where people actually are starting to call for cuts earlier, I think is probably the number one thing I'm looking for.
Yeah, we'll certainly be paying attention to that PCE data later this week. Josh Schaefer, thanks so much. All right, 2024 is getting a lot of bullish stock market forecasts from strategists, or I should say more. But based on past calls, how seriously can we take these opinions? Our very own Jared Blickery is here to break down strategist sentiment.
Yeah, not to pour cold water over, all the talk about 2024 that we're talking about, but let's dial back 1 year ago. And this is a chart going all the way back to 2000, what analysts thought, strategists thought the S&P 500 was going to return in the following year. And guess what? Right down here 1 year ago, analysts thought that this was going to be a negative year of returns for the S&P 500. Of course, that hasn't happened, but it's interesting to note this, but also important to realize that a lot of time analysts are just extrapolating in a linear fashion from whatever is happening at the time. So at the end of last year, investors were shell-shocked from the historic rise in interest rates, the most blistering pace that we'd seen in 40 years, and this saw considerable hits in the stock market. But I want to get to the present here. This is what analysts are so far expecting for 2024, an average price target of 4610 in the S&P 500. Well, the current price is only 4,500, and this is only an average, but we were just talking about the estimated EPS of $230. Let me show you some of the more bullish calls here. Deutsche Bank, BMO, expecting 5,100, but still that would only be a 13% rise from where the S&P 500 currently is. So back to my main point, analysts tend to extrapolate into the future whatever is happening right now. And what's happening right now is we are seeing incredible outperformance from the mega caps. This hasn't just been a first half of the year story as it was. They have reignited. This is month to date. This is what's happened in the month of November. Apple up over 10%, Microsoft up over 11%, so is Amazon. NVIDIA up another 18%. When you take a look at the year-to-date totals, $229 for NVIDIA. Investors might be a little bit too optimistic about the prospects for tech going into 2024. So enjoy the 2023 rally while it lasts. As I've been saying, there's a lot of catch up to be done, and Wall Street analysts and portfolio managers are just clamoring to hold the right stuff at the end of the year. But heading into the new year, very likely to see different dynamics at play here.
All right, we will keep watch for exactly what dynamics are at play as we look ahead into 2024. Jared, thanks so much for breaking that down. Well, we've got soaring mortgage rates are becoming a real problem for the housing market. We just got new data out this morning. Home sales seeing a 5.6% drop in the month of October. That was versus September's numbers. And now sellers are feeling the pressure to lower their home prices. New Redfin data found that over 20% of homes that sold in October lowered the price of those homes. So joining us now is Daryl Fairweather, Redfin's chief economist. Daryl, it's great to see you here. So a 5.6% drop in new home sales, certainly a number that's jumping out to us this morning. What are you seeing, though, on your site currently? Because we have seen mortgage rates fall a bit here over the last several weeks.
Yes, in the last several weeks, it's become better for buyers because mortgage rates have come down and new listings have been increasing. So overall, that's just better news for buyers. But, it's going to take a while for buyers to really internalize these lower mortgage rates. There aren't that many buyers on the market this time of year at the holidays. So it may get a few buyers off of the sidelines, but I think it's going to take until next year and continued declines in mortgage rates for us to see some real strength in demand.
Daryl, speaking of next year, what are your expectations for how the housing market will look, especially when you think about the first quarter of next year?
Well, I'm more optimistic now than I was just a couple of weeks ago when mortgage rates were getting close to 8%. The fact they've come down a little bit makes me more optimistic, but I think it's going to be another slow year, at least when we look back historically. We had so many sales during the pandemic that right now we're still kind of in this hangover and rates aren't helping the situation. There are going to be more people who are wanting to move because they have a new job or they're getting married or they're having kids. So people's lives go on and that creates demand. And if we have a strong stock market, people may feel good about spending money, but those high rates are the biggest drag on the housing market right now.
Yeah, Daryl, you mentioned the fact that we need to see some material improvement here, more declines in mortgage rates in order to see that boost in demand. What level do mortgage rates need to fall to in order to really be a catalyst here for the housing market?
If rates fall below 7%, I think we're going to have a surprisingly strong year. That's when I think we're going to see more people out there with bidding wars even, which is pretty strange because back during the pandemic, rates were 3%, but rates going up to nearly 8% has reset the threshold, I think, for buyers wanting to get back into the market.
And are you expecting, what's your expectations for the all cash buyer? That had been previously a big part of the demand picture when it comes to home sales. What's your expectations for the cash buyer? Will it still be, say, a third of home sales in 2024?
We've seen more cash buyers right now just in terms of the share, but during the pandemic, there were a lot of cash buyers too, because cash is always king. It helps you win bidding wars. So even if rates come down, I think people will still continue to use cash as a way to win bidding wars, but they may go back and refinance right after the deal closes and actually get a mortgage. Doesn't mean that they're not getting a mortgage on the home. Right now, cash is helping people wait out the mortgage situation. Maybe they'll get a mortgage later when rates come down, but I think cash is still going to be a key strategy for winning a home.
So does that then tell us about home prices? If we're going to see more bidding wars, are we going to see prices head even higher?
Well, we're talking about a scenario where rates fall. If rates fall, we will see more buyers come back to the market, and with limited inventory, that will create bidding wars that push up prices. We're seeing a bit of relief on new listings right now, with more sellers deciding now is the best time to sell, and maybe that will continue into next year. So hopefully we'll have a bit of a balanced situation, even if rates do decline, but I don't think that balance is going to last. The overall story for the housing market is that there are fewer homes available compared to the number of people who want to buy a home.
Where is inventory the best in terms of geographically speaking, Daryl?
It's best on the coast, especially the West Coast and San Francisco and Los Angeles. That's where those high rates are really hitting hard. And also it's where sellers can sell and then they have all this equity that they could take to a more affordable market. If you're selling $1 million home on the West Coast, and you have paid off most of the mortgage, you can take that cash and buy something with all cash in Arizona or Florida or another more affordable market, and you can get around the whole mortgage rate problem. So that has created more listings, more inventory on the coast compared to some of those more affordable markets where there are buyers still coming in and not many people willing to sell.
Daryl, a lot of people have been priced out of the market given the fact that mortgage rates have been soaring, prices remain very high, so they've been forced to rent. What are you seeing in terms of some of the trends in the rental market? Are we continuing to see maybe a bit of softening there?
This year has been a good year for renters, and with the housing market being so tough, with rates being so high, it's been nice that people have been able to go to the rental market and at least their rents aren't going up dramatically from last year. I think next year, though, there's going to be more demand for rentals. For those 3-bedroom rentals that are very comparable to a starter home, I think there's going to be a lot of demand there and rents will increase. But for 0 to 1-bedroom rentals, there's a lot of new inventory coming online, and with more supply relative to demand, prices could fall for those smaller rental units.
All right, Daryl, we will have to put a pin in our conversation. It's always great to hear from you. Daryl Fairweather, Redfin Chief Economist. We've got more of your markets action ahead. Stay tuned. You're watching Yahoo Finance. There's new life for the Hunger Games franchise. 8 years after the saga's last release, its new installment, The Ballad of Songbirds and Snakes, took the top spot at the Thanksgiving box office this year, raking in $42 million. But more disappointment came for Disney with its latest release, Wish, tallying just under $32 million for the holiday weekend, well below expectations. For more on the state of the box office, we're joined by Gitesh Pandya, box office guru, founder, and editor. Thanks so much for joining us.
Great to be here.
So I want to start with Disney. There were expectations going into this that Disney would bring in at least $45 million. What is it going to take for Disney to reclaim its magic at the box office?
Well, it's got to be a selection of just fantastic films, exciting films. People have tremendous options at home. One of the things consumers are thinking about is, do I need to spend $60, $70 as a family in a movie theater right now, or can I wait for Disney Plus later? So that's something which Wish didn't have. They tried all the marketing, but the excitement just wasn't there. The numbers on this were really low, even by Disney standards and Thanksgiving standards. We're at The Penguins of Madagascar is the last film which had this level of low at Thanksgiving.
Yeah. Gitesh, when you talk about some of the underperformance here, a lot of the focus has been on Disney, obviously on Iger. When we talk about the underperformance recently of animation films, when we talk about the underperformance of Marvel films, is too much being placed on that just as an overall statement, or do you think there is some real reason that Disney should potentially shift its focus and its strategy going forward?
Well, I think part of it is within Disney, part of it is systemic in the industry overall. Definitely they have spread themselves across so many different projects. They've got all the streaming projects along with the theatrical releases. The question is, can you sustain a high level of quality with so many projects out there? I think a lot of the Marvel movie fans will say the last year or two, the quality has kind of gone down. Mm-hmm. And then the streaming titles, you have to sort of watch one to know the overall storyline with the rest. Some people complain about that. The Marvels is coming off of a very bad opening a couple of weeks ago, lowest numbers ever for the Marvel Cinematic Universe. Now Wish, some of the lowest numbers ever for Disney animation. And so, you can't sustain this for too long. You really have to focus maybe on a smaller number of films and do them really, really well.
Yeah. Let's talk about some of the surprises at the box office. So Napoleon did better than Wish. What do you make of that?
Well, that's a surprise. I mean, Wish has a broader audience. It's a family audience. It's PG. Everyone can kind of go. Napoleon is rated R. It's a historical biopic. It's a more narrow audience. But over the 3-day period, you talk about over $20 million. And it's a very expensive film. I have to say, I saw the film. It's okay. It's a pretty good film. If you're a history buff, you'll probably like it more than anyone else. But, Ridley Scott at age 84, 85, he still got it. He really made this film very well. The battle scenes are there, but also the acting he gets out of his actors is quite good as well. This is a film that's made to make most of its money overseas. Probably 75% of the global box office will come from outside North America, so they're in pretty good shape. And this one is paid for by Apple. This is Apple with the deep pockets, spending a blank check for big directors like Martin Scorsese and Ridley Scott. Make whatever movie you want, we'll pay for it, and we'll get it onto the Apple TV Plus very soon. So, business-wise, I think Apple will be okay with what their broader strategy is.
Gitesh, when you take a look at the overall numbers that we're getting from the box office this weekend, Thanksgiving box office bringing in $172 million. Yes, a lot to be excited about there, but still far lower than the numbers that we saw pre-pandemic. Right. Are we ever going to get back to those pre-pandemic levels when we're talking about Thanksgiving weekend? And I guess how important is it for studios when they're figuring out their release dates to try and release their biggest hits around some of those holidays?
Well, I think we will eventually get back to those pre-pandemic levels. The good news is that this is the first time that the top 10 over Thanksgiving weekend broke $100 million since 2019. Mm-hmm. So over the last 3 years, we haven't seen that. So it is sort of getting back to that level.
The way that studios usually operate is that the first weekend of November is the start of the holiday season. Huge movie gets programmed there. This year, it was supposed to be Dune Part 2, which would have been a big hit, but because of the actors' strike, they bumped it into next spring. So that was gone. And then you've got Marvel's in the middle there, and then the weekend before Thanksgiving has been used by some of these young adult novels turned movies, like Hunger Games and Twilight and so on, Fantastic Beasts, to become big blockbusters at this time of year and then do well on the second weekend for Thanksgiving. But Hunger Games, which was a surprise #1 this weekend, is doing well for a low-budget $100 million kind of project. But I think in the years to come, we're going to see more bigger franchise titles move into that Thanksgiving, pre-Thanksgiving corridor to bring back the grosses of old days.
Do you think the sluggishness, when we think about this Thanksgiving weekend compared to previous holiday weekends, is attributed to the lag coming off of the strikes and the marketing push that needs to happen, especially when we think about the huge marketing push we had this summer into the Barbenheimer? Right. Do you think that was a big part of what we're seeing in the numbers?
It was definitely a component. I mean, we all know people love their celebrities. They just love their celebrities. They talk on social media, they do interviews, they're out there selling their projects. So most of that was gone for a couple of months over this fall season. Now, they did come back a few weeks ago. These movies opening over Thanksgiving did have their actors, at least in the last 2 weeks or so, promoting their films, and these are the results. So the actors can only go so far in promoting it. When people don't feel the excitement for something and they're asked to pay a record high ticket price for these movies, they're going to decide whether to skip it or not. And films come out on streaming faster than ever, so that's part of the equation. You got to make high quality films and have that excitement around it, the can't miss excitement, because the experience is more and more part of the box office.
Is Godzilla going to do that next weekend?
I think Godzilla would do well. There's a new Godzilla movie. It's not a Hollywood film. It's Japan's Godzilla movies. A lot of people know for 70 years, this is the 30th Godzilla movie. Most of them don't come to the US. This one's called Godzilla -1. It opens this coming weekend. It's going to be in theaters all across the nation. It should do pretty well, certainly for that Godzilla. The screening I went to, people were hooting and hollering, clapping at the end. But then there's also the Beyonce movie. That would be the bigger one. That's a concert film. It's going to be opening in on 2,000, 3,000 screens. Quite possibly could be the #1 movie next weekend. And it's not going to do the Taylor Swift numbers. The pre-sales are not at the same level. But still, for a concert movie, it's going to be one of the highest grossing concert movies of all time, I think.
It's pretty amazing, the numbers that Taylor Swift pulled in for that. And then, of course, when you take a look at the anticipation here for Beyonce's numbers. All right, Gitesh, always great to have you. Thanks so much.
Always a pleasure.
Thank you.
Keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back. Cyber Monday is set to break records. Adobe expecting folks to spend upwards of $12 billion today. That's higher than initial projections. And it would also make this year's Cyber Monday the biggest online shopping day of all time. Now, shoppers have already spent a whopping $10.3 billion over Saturday and Sunday, and surpassing the e-commerce spend on Black Friday. Now, sales across the 3 days were up almost 8%. Though people are shopping more, many, though, are turning to buy now, pay later to stretch their budgets. Adobe predicting that the BNPL usage will hit a record high today. With us now for more, we want to bring in Patrick Brown. He's Adobe's Vice President of Growth Insights. Patrick, it's great to have you here. So breaking down some of the spending that you're anticipating to see today and really what we've already seen play out over the last several days. Is that because we're seeing an increase in demand, or is it simply because higher prices are driving these year-over-year jumps?
Yeah, it's a great question. And so what we're looking at, just a quick touch on the actual data, is we're looking at, through Adobe Analytics, actual online transactions. And we break those into about 18 different product SKUs. It's like 100 million product SKUs that we're looking at, and 18 different categories like electronics and toys. And we trend that over time. And so what we're seeing when we trend that over, in our data is strong growth, like you called out, which was about a 5% increase on Thanksgiving, acceleration of about 8% through Black Friday, and then even another 8% over the weekend. So really strong growth. The biggest driver for that we see is the discounting. And so we see discounts of around 20-25% on products like electronics and toys through the weekend. And we expect that to peak with discounts around 30% today on Cyber Monday. One of the big drivers, like you did call out, is an increase in buy now, pay later. And so people are seeing bigger discounts. They're leveraging credit and different ways to defer payments to be able to take advantage of some of those good deals that they are seeing. And we're expecting that to peak today.
So you're expecting that to peak today when you think about the discounting trend. I have seen some brands advertise Cyber Week. So can we expect to see kind of an extension of some of the discounting through the balance of this week, Patrick?
Yeah, that's usually what happens. And I think what retailers are seeing is they're seeing some of the strength in the numbers as well. And so depending on how they're looking for the year, they may choose to peak their discounts today, or they may choose to extend them depending on what they're seeing from a sales perspective. I think consumer demand, given the numbers that we're seeing, and even the increase in our expectation for today, is showing to be resilient. Consumers are looking to spend. I think retailers are realizing that. And we likely will see some of those discounts extending through into December.
Patrick, what are some of the hot sellers? What are people spending on?
It's, consistently it's electronics and toys. Those are the things that really lead the day. We saw a massive increase in online sales in electronics, 171% increase week over week leading into Thanksgiving. And then other categories like toys, jewelry, personal care products, it starts to spread out through the other different categories. Cyber Monday usually is about technical things, appropriately called. We see electronics, we see TVs, and that's also where we see the peak discounts. We expect today to reach nearly 30% in discounting in some of the areas like electronics.
And Patrick, how much does mobile make up of these sales?
Yeah, this has been an interesting year for mobile. This is the first time we've seen sales on mobile eclipse desktop, which these numbers will be updated through Monday, where mobile will actually take up a larger percentage of the share. And interestingly, on Thanksgiving, we see that spike. Nearly 60% of the sales are mobile around Thanksgiving, as people are maybe not around their computers and taking a little bit of break from family and friends to do a little bit of shopping. And then on Cyber Monday, it goes back to a little more desktop. But this will be an interesting year as we see mobile becoming the predominant sales channel for online retail.
So Patrick, are consumers even more resilient than maybe you were anticipating going into this holiday quarter? We mentioned the fact that so many consumers had pulled back on their spending on discretionary goods, but taking a look at the data that you guys have provided so far, it seems like with electronics and toys right up there topping the list, that isn't necessarily the case.
I think we've seen additional strength because consumers are feeling like they've gotten a good deal. There's two things at play here in our data. We've seen 14 consistent months of online deflation, where it feels like prices are coming down online, even in some of the stickier categories like grocery, which even for online has been one of the more price-resistant categories. And so prices are coming down, and then we see discounts on top of that. I think those two things combined have driven a huge increase in demand, and consumers are feeling like they've gotten a better deal. And we've seen that through the holidays as we've been increasing our expectations. And then also we're seeing people are leveraging services like buy now, pay later, where they're able to extend their credit and extend their payment periods to be able to manage their wallets more effectively.
Patrick, a couple things that just stood out to me that you said feel like they're getting a deal. I've heard this saying before, feelings aren't facts. So we will see with this rise of BNPL if consumers are really just kicking the can down the road. All right.
Yeah, it's an interesting topic. That's one that we're definitely watching.
All right, Patrick Brown, Adobe's Vice President of Growth Insights. Thanks so much for the latest data on Cyber Monday, Black Friday, Cyber Weekend. We appreciate it.
Thank you. Appreciate the time.
We've got more of your market action ahead. Stay tuned. You're watching Yahoo Finance. Well, the holidays are here, and if you're one of those people running around a mall, inevitably looking for a last-minute gift for a loved one, this year could be different. A new Yahoo Finance and Ipsos poll suggests the gift of stocks or other investments this holiday season may be just the ticket. The results tell the story. Around 70% of Americans say they would be happy to receive an investment as a gift. Only 6% of Americans say they would be let down by receiving an investment this holiday season. Roughly 61% would like the investment to help save for the future. 54% see investments as a means to build wealth, and 23% are aiming to beat inflation. I thought this was such a neat poll, Shauna. When you think about what you would like as a stocking stuffer, I mean, that's a yes for me. I was surprised that there was anyone who said no.
Yeah, obviously, if you're gifted a smart investment here, it could certainly pay off in the future. But I think it also points to this FOMO rally that we've been talking about now for the last several weeks. So many investors are trying to get in right now and capitalize on some of the momentum that we've seen from the Magnificent Seven since the start of the year. When you take a look at the gains in Microsoft, Amazon, Nvidia alone being up just over 200%, certainly there is a lot of excitement to potentially profit off some of these types of investments. When it comes to this poll, in terms of what stood out to me was who is most excited about these investment gifts. Higher income group, those making over 100,000, 74% of those that responded said that they would be pleased with an investment gift, compared to just over a half, just about 58% of those earning less than 50,000 saying that they would also be excited about it. 15% of Americans polled saying that it's a good way to help pay off some of the debt that they have racked up here over the year. So Obviously, it makes a heck of a lot of sense, of course, if you receive some of those investments and then hold it for a substantial amount of time and let maybe those investments grow over a period of time. All right, well, that does it for us today on Yahoo Finance, but keep it right here. We have Rochelle Akufo and Akiko Fujita for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo with Akiko Fujita. Here's a look at what we're watching this morning. Blockbuster numbers from Black Friday. What does it tell us about the state of the consumer? And is Cyber Monday in for a similar outcome?
And oil fluctuating following OPEC's decision to delay its key meeting on supply policy is further tightening on the horizon.
Indeed. Plus, The Hunger Games topping theaters again with its latest release, but Disney's numbers disappoint. We'll break down the holiday box office later this hour.
But first, let's take a look at where the markets are trading right now. 90 minutes into the trading day, investors taking a bit of a breather here, coming back from an extended holiday weekend with all three major indices seeing red across the board. The Nasdaq sort of fluctuating right there at the flat line. The Dow down 71 points, the S&P 500 down 7. In terms of sectors, we're watching energy, the biggest laggard on the day. We were just talking about that delay in the OPEC decision. Energy as a whole down about 0.7%. Let's take a look at where Treasury markets are right now. Bond yields all pulling back today. We've got some key economic data coming on later this week, consumer confidence as well as PCE. But ahead of that, we see all of those yields on the shorter end as well as the longer end pulling back right now. Well, we are about 90 minutes into the trading day on the last Monday of November. Here to break down the latest stock moves is our very own Jared Flickery. Jared, tell us how those retail stocks are moving. Certainly going to be in focus today, or have been in focus, with Cyber Monday wrapping out a very, very busy shopping weekend.
You bet, Akiko. And I think it's fitting that consumer discretionary, that's retail, the best performing large cap sector today. But first, I wanted to go through some of our trending tickers here. A lot of retail oriented names Shopify, number one, that's up almost 4%. Affirm, that's buy now, pay later, that's up over 11%. Big day there. Ulta Beauty in the beauty space, that's down just fractionally. We have Shopify, again, that's a Toronto ticker. And then, of course, Amazon, the biggest of them all, that is up over 1%. And I thought we'd get into some heat map action to show not only what has happened today, but what has happened over the last 5 trading days. That takes us back to that bullish week, Thanksgiving week that kicked off 1 week ago with bullish expectations, seasonally speaking, into the end of the year. So here's what's happened today. I was just talking about Amazon. That's up 1%. Shopify, another outlier. Let's take a look at the 5-day view here. And that's when we see some more impressive numbers getting posted. Looks like Wayfair up 9%, Gap up 6%, Kroger 4%. And if we take a look inside, apparel especially has been doing pretty well. And let's sort by performance so we can see some of the big winners and losers there. Skechers up 7%. Looks like Crocs up 4%, Foot Locker 4%. But it's not all winners here. We have some losers as well. AEO, that's down 14%, and Urban Outfitters, that's down about 11%. So take it how you will, but we've talked about luxury being kind of the alternate Magnificent Seven, at least in Europe for a big part of the year. Here's what's happened over the last 5 days, and I'll just show you kind of a mixed board today as well. You might not expect all those doorbusters and deal breakers in a brand name like Hermès. Nevertheless, we have seen a lot of outperformance by several in this group, not quite the Magnificent Seven that we've seen in the United States, but nevertheless, just tracking that for you. Finally, just want to head and look at the sector action. I mentioned consumer discretionary was the best before. Actually, it's real estate right now. That's just a little bit better, up 28 basis points. Tech barely in the green, but for the most part, stocks taking a little bit of a downbeat. Energy, as Akiko was pointing out with that OPEC Plus delayed decision, that's down 0.6%. Materials and healthcare also down 0.5%, guys.
Appreciate you tracking all of that for us. Our very own Jared Blickering. Well, today is the last day of the busy holiday shopping weekend, and according to data from Adobe, shoppers spent a record $10.3 billion in online sales over the past few days. That's a 7.7% increase year over year. So what does this weekend's numbers tell us about the state of the consumer? Well, with us now is Kelsey Jones, SAP Amaris's Global Product Marketing Head. Thank you for joining us today. So obviously, we heard a lot of caution in the earnings calls about the consumer pulling back. Then we get this blockbuster number so far. What are your big takeaways from spending so far this holiday weekend?
Yeah, absolutely. It has been, like you said, a blockbuster weekend. But I think what's really interesting is kind of when we look at our digital marketing platform, we can see that retailers have already been driving and starting their campaigns earlier than ever this year, right? This is happening, across the whole month rather and into Black Friday and Cyber Monday weekend. But it's really creating a bigger opportunity for retailers, I think. It gives them an opportunity to not only find new customers now with the right discounts and the right offers, but then extend those into loyal customers as they go throughout the holiday season and into the new year.
What does that suggest in terms of where we're headed in the weeks ahead? I mean, I saw myself a lot of heavy discounting already. That doesn't necessarily bode well for retailers, right? If that's the expectation going in.
Yeah, I think it's spread out, right? I think some of our research is showing us that consumers' spend is dropping, but they're planning to do their majority of shopping over the next, 2 weeks here. When you get about 18 days out of Christmas is when people really start to make sure they're panic buying and getting the right offers at the right time. I think right now what we're seeing is continuous influx. Even as the day goes on today, we're seeing higher and higher volume sends of retailers reaching out to their consumers and driving more deals longer than I think they have before, right? Sometimes we just see it on a Black Friday or a Cyber Monday. I think we'll see some of those discounts trickle into as we even get closer into Christmas and into the holiday season. So I don't think that's going to back down necessarily, but it's really going to be about finding the right offer and the right mix that we're engaging with consumers is what's going to be the most important as we get through the holiday season.
And Kelsey, as we look at some of the products that have been really leading the charge here, looking at gaming, beauty, and tech coming in from Black Friday and the weekend. But what about Cyber Monday? What's going to be the driving force today?
Yeah, I think kind of the numbers that we were just walking through on the screen, I don't think are going to go away. I think we're going to see apparel as continuing to drive. I was looking even at myself in my other browser of what I'm looking at to purchase today. I think buying gifts and things are not going to go away. Toys, apparel, and electronics are the biggest drivers that we've been seeing. Even from some of the brands that are using like Puma and Gibson guitars, they're really driving a lot of traffic as we get through, even through today. But I think we're even seeing bigger numbers, even through Cyber Monday, even before we come off of Black Friday weekend.
Yeah, Kelsey, I wonder if you can hit on a bit more about how these brands are trying to cut through some of that noise, you know, whether it's on social and trying to find that right target audience to really blast that promotion out there. You mentioned in your notes some of the AI tools that have been utilized as well. How is this year different?
Yeah, I think you're exactly right. Cutting through the noise, the consumer is more empowered than ever. They're more savvy than ever. They have more information at their fingertips. In order for retailers to really cut through this noise, the key is omni-channel personalization. And that is really kind of a mouthful of a buzzword, but it's kind of twofold, right? We think one, retailers need to make sure that they're providing a value exchange for their consumers. That means when I give you my phone number, my email, what am I going to get in return for that data that I'm providing you? But then we also have to build trust into that. And that's the AI components that come in to also help retailers scale, right? We need to make sure we're segmenting and personalizing those communications as retailers to cut through the noise, to make my offer stand out and be different. And doing that at scale is where AI is really behind the scenes. You know, the big factor of that, we've seen over 300% rise in our segmentation and personalization capabilities. So brands are doing it. They're figuring out ways to connect with people, not just the right content or the right offer, but also what's the right channel? Should I be engaging with them when they're walking into my store with a mobile wallet? Should I be engaging with them, like you mentioned, on social media? There's a different time and a place for different offers that we're providing. And AI is really a big driver on doing that when you have such a high volume that retailers are trying to cut through to get to reach kind of each individual consumer.
And Kelsey, I want to ask you about something that it looked like Adobe Analytics was almost downplaying the role of inflation here, saying that strong consumer spending online was being driven by net new demand and not higher prices. But then when you factor in inflation, when you factor in these promotional deals won't last forever, what does that mean for customer retention and where the consumer goes from here?
Yeah, that's a great question. I think the comment was around kind of feeling versus facts, kind of customers feeling like they are getting a really great offer and a deal. I think that's also really important when you think about engaging across those different touch points. When you're retaining customers, it's really about, it's not just the last experience you had, but each touch point along the way. Am I going online and ordering? What's the inventory status? How much is in stock? When I purchase it, how transparent are we being throughout the delivery process to the time that it hits my front doorstep, to the time I can deliver it to my niece who needs to try on, to maybe having to return and exchange? That is a full different types of experiences and touch points that happen. And retailers have to be able to understand that data coming in and being able to serve that customer at the right moment to retain them so they're coming back next year to buy again for their second and third purchase. So I think it's a shorter discount here may be great to secure the customer, but in order to retain them, right, they really need to think longer term and engaging on and providing all those different personalized experiences every step of the way, even through the holiday season and into 2024.
Certainly the case, especially with so much competition out there. Kelsey Jones, SAP Amarsis Global Product Marketing Head. Good to talk to you today. Appreciate the time.
Thank you, guys.
Shares in large Chinese property developers falling today. Over the weekend, Beijing police launched an investigation into Zhongxi Enterprise Group, a Chinese shadow bank. That's according to local news. This is reigniting fears that the country's real estate slump may be affecting banks. Just last week, the shadow bank told investors it was severely insolvent and its debt was huge. Shadow banking refers to financial services offered outside the formal banking system. Shadow banks can more easily lend money to more entities, but they're not subject to the same regulatory oversight as traditional banks. And Rochelle, really, this is about the concerns about the contagion effect spreading beyond the real estate sector into the financial sector. And it's worth kind of taking a step back for those who haven't necessarily been following the China story here about why shadow banking poses such a significant risk when you look at the overall Chinese economy. The banking system, largely state-run in China, which means that businesses that aren't necessarily backed by the state have a harder time getting loans, securing loans. That's why they shadow banks, I should say, have played a significant role in the massive growth that we have seen, particularly in the real estate sector. But just as quickly as they've gone up, the concern is how quickly they can come down. And, we should point out, China's been trying to crack down on shadow banks for many, many years. But this has really just reignited the very risk that China watchers have been honing in on for many years.
It's true, and it certainly seems to be coming to a head here. I mean, when you think of China's property sector accounting for about a quarter of its economy, when you think of the domino effect from a lot of this debt, a lot of these developers holding this debt, it means that consumers who have seen a slowdown in what they're looking at with real estate. In fact, as we look at some data from McKinsey, they did a correlation between, in their China consumption, the start of a new era survey, tracking the slowdown in residential property transactions alongside the drop in consumer confidence. Now, some of that also factored in things like geopolitical conflict as well. But it does mean that when people don't feel confident that they can buy a home as a way to build their wealth, they start pulling back as consumers. And so when you look at some of the most exposed multinational companies that are exposed to China, you're thinking Apple, Nvidia, Broadcom, Nike, Starbucks. So some concern in the short term, but analysts seem to see some long-term optimism, at least in the consumer-driven economy that China is having. But that domino effect, it still keeps lingering, it still keeps rearing its head. So you have to wonder if a shock to the system, that perhaps the PBOC or the government can try and support this property market better, but it still keeps becoming that nagging issue that especially multinational companies should stay on top of.
Yeah, and there's a lot of debates among China watchers about really how this trickles out beyond China. We always sort of hear people use that word Lehman moment. That's not necessarily, you could argue, what's happening here, because that trickle out effect going out from China, still a little unknown. But worth noting, when we're talking Zhongxi specifically, this shadow bank, $64 billion in liabilities is what the company has flagged already. That came out last week. The shadow bank industry as a whole, some estimates put that at $3 trillion. So that is a huge, huge exposure, and a lot of that exposure is going into the real estate sector. So something to very closely watch moving forward here. Well, we've got all your markets action ahead. Stay tuned. You are watching Yahoo Finance.
A tale of two commodities, oil prices fluctuating following OPEC's decision to delay its key meeting on supply policy to November 30th as members remain divided over quotas. But it's a different story for gold, rising to a 6-month high today, driven by a weaker dollar. Yahoo Finance's Inez Ferrer has the details for us. So, Inez, what are you watching here?
Yeah, Rochelle. Well, let's start with what's happening with oil and then we'll get to gold. But first, with oil, we have seen some wavering prices today ahead of that OPEC Plus meeting, which has been rescheduled for this Thursday. A big surprise to the markets last week when OPEC announced that it was rescheduling that meeting. And that's because of disagreement among member states and Saudi Arabia wanting some of the smaller members to bear some of the burden when it comes to more production cuts. So, and anticipation really as to what OPEC Plus will announce regarding its production cuts. But if we take a look at where we're at with Brent crude and WTI, we're looking at fractionally lower prices, though you did see a little bit of a spike here earlier into the green territory, but WTI is hovering just above $75 a barrel. Brent crude is hovering just over $80 a barrel. Look, crude prices are down about 20% from their average in 2022. They're down about 19% from their highs in 2023, their 2023 highs. And this is despite those production cuts that OPEC Plus has in place, despite the unilateral cuts which Saudi Arabia has in place. So there is a concern in the market about growing supply and also falling demand. You've got the U.S., which has been in record oil production coming out of the U.S. You've got non-OPEC members, which are producing more oil. And so the forecasts are that next year, you are going to see more of a supply of oil in the market. And you may see some demand softening in places like Europe. You've got China refineries, which are refining less. A different story when it comes to the other commodity that we want to talk about, which is gold. Gold has been in demand year to date. This is a year to date chart for gold. Quite volatile for the year, up 9%. But if we take a look, this is a level that we're very interested in, up above $2,000 an ounce. This is around a 6-month high. We are seeing a little bit of a weaker dollar index, so that's lifting gold prices. The markets, though, are anticipating that the Federal Reserve is done raising interest rates, and gold doesn't pay any income. So when you have higher rates, it's less attractive when the rates are high. It's more attractive when the rates fall. But we also have been seeing central banks buying at a record pace. And I'm going to pull up a chart which Jared Blickery put up. And he basically took note earlier this morning about how central banks have been buying up gold. This is 2022. Here's 2023. But remember that this is just to the third quarter of 2023. So central banks are diversifying their reserves, buying up gold, trying to wean away a little bit from the U.S. dollar. Also, as their currencies are depreciating, they're buying up this gold. So this has also raised demand for gold.
Okay, and as for breaking down the commodity space for us today, thanks so much.
Thank you.
Well, stocks searching for direction to kick off the week as investors look ahead to the release of the Fed's preferred inflation gauge later this week. But our next guest is warning of a rocky road ahead as the market looks to get ahead of rate cuts. Let's bring in Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Kathy, good to talk to you today. Taking a look at where yields are now, sort of quieted that talk about this march to 5% when it comes to the 10-year, but it sounds like you think this pullback isn't necessarily going to be a straight line down.
Yeah, I think that that's going to be the story. It has been the story, over the past 6 months or so. I think that's going to continue to be the story into 2024 because the Fed's reaction function is just different this time and probably more unpredictable this time. So on the one hand, they've tightened a lot. And they've driven real rates up. They're doing quantitative tightening. They're taking a lot of steps to really slow the economy, and inflation is coming down. In a normal cycle, you would expect the Fed to start easing sooner rather than later as inflation gets closer to 2%, as the economy shows signs of slowing down. But in this cycle, because inflation has surprised on the upside, the Fed seems more cautious. And I think trying to figure out the Fed's reaction function is going to be the source of volatility as we go into next year.
And certainly the market's jumping ahead, expecting those rate cuts in the first half of the year. But one of the contributing factors that you're looking at with this drawdown in bond yields is that slowdown in growth. And I know we've talked a lot about credit card debt, but we're also seeing that become delinquencies. And we're seeing that across all loans, according to the New York Fed, except for student loans and home equity lines of credit. What is that lag effect when it comes to the consumer? When is the rubber going to hit the road there?
Well, I think it's starting to. As you pointed out, delinquencies are rising on credit cards, auto loans, lots of trouble in the auto, especially the subprime auto area, people not able to get financing. We're starting to see some catch up among smaller businesses that are financing at very high rates right now, 8%, 10%, et cetera, and have to roll over those loans at a pretty consistent basis on a short-term basis. So we're starting to see it. But it's going to take some time. And I think one thing about the consumer we have to keep in mind is as long as people have jobs, they will continue to spend. It's just their ability to spend a certain amount at a certain pace that's probably going to slow down. And then when we start to see more job losses or certainly less hiring, that's probably when we see the consumer really pull back.
Yeah, so far the job market remaining resilient, though. Kathy, we've got the PCE data coming out later this week, the Fed's preferred inflation gauge. What's your expectation on that front, and how are we likely to see it reflected in the bond market, the reaction?
Yeah, we're expecting a slight increase this month, a month-to-month basis, but a year-over-year continue to decline, modestly. I think we get more of a kick in the next 6 months to the downside. But that it really has fallen almost by half now over the past year from the peak. And we think that trend will continue. When you look at CPI, it's mostly about rent. When you look at PCE, there's a lot of different components in there. Healthcare is a bigger factor. But overall, when we start to take into account the big drop in commodity prices that's taken place so far, the slowdown that we're seeing in the service sector indices from ISM, all pointing to less and less inflation. And we're already ahead of what the Fed was estimating for the end of the year. So I think that this will give them confidence that as we move into next year, inflation is going to get a lot closer to their target than it has been over the last 6 months.
So Kathy, for investors looking at their portfolios, what is a top opportunity that you see and what are you steering clear of?
Yeah, what we really have been suggesting for most investors is this up in quality, intermediate term duration. And by that, I mean up in quality, treasuries, other government-backed securities, investment-grade corporate bonds, high-grade municipal bonds. Those yields, if you're in a duration that's around 6 or 7, which is kind of a benchmark for the aggregate bond index, those yields are north of 6% in the corporate bond market. And we think that, a high quality portfolio with that kind of duration is not a huge risk. And it is an opportunity because you're locking in pretty good yields for the next 5, 6, 7 years. And you can go off and, worry about your equity somewhere, on the other side of the portfolio will give you a lot more volatility, but locking in that cash flow with a certain amount of confidence, we think is an opportunity. Where we're staying away from is the lower credit quality, whether it's high yield or bank loans. Our concern is just that as the economy slows down, as those financing costs really sink in, we're going to see more default, and the market's just not priced for that.
Certainly a lot to take in there. Good takeaways. Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Good to talk to you today.
Thank you.
All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard
hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Is the American dream dead? Well, 45% of people believe that the dream does not hold true anymore. That's according to a Wall Street Journal poll out last week, while only 36% of people believe that it's still possible to work hard and get ahead. That's down from 53% a little over a decade ago. To break down the numbers for us, let's bring in Aaron Zitner, Wall Street Journal reporter. Aaron, not exactly the most uplifting poll here, but let's start by talking about what exactly the American dream is. How do you even define it now?
Well, there are a lot of ways you could define it. We defined it explicitly in the question. We said the American dream is the ideal that anyone in this country who works hard can get ahead and improve themselves economically. And we asked people, is that still the case? Was it never the case? Or was it once the case, but it no longer is true? And you just showed the numbers that we found, that 36% who said that the dream still holds true and the American dream still holds in this country. If you work hard, you can get ahead. That was the headline number, because that 36% was lower by a lot than a decade ago. It was above 50% in 2012. And that 18% who said there never was an American dream in this country, a decade ago, only 4% said that that was the case in similar polling done on the exact same question, but by a different pollster. So this is a much more dour reading of the American dream and the prospects for advancement.
And Aaron, this is fascinating. I mean, the term was popularized back in 1931. Clearly, a lot has changed since then. But the fact that we've seen such a drop from 2012, after people have come off the back of a financial crisis, what do we think is the fundamental difference between what we've seen in 2012 versus how people are feeling now?
Well, you know, I had to talk to people to get a sense of what was behind their responses. And I called a number of the people who participated in the poll. And I heard kind of things that fell into two buckets. One was short-term immediate concerns, namely inflation and mortgage interest rates. But then other people engaged with this as kind of we intended, which was a long-term question. And they spoke to structural changes in the economy. So in the short term, I heard people say, look, you're asking if you work hard, can you get ahead? Well, with inflation the way it is, I can work harder, but I'll stay just where I am because I have to make up for inflation. People who answered about long-term structural changes pointed to things like, hey, you know, my father had a pension. I'm responsible for my own retirement. They were talking about the risk shift from corporations onto individuals in retirement. Yeah, we all get to benefit from the stock market and our 401ks, but we're responsible for ourselves. One thing that I didn't hear, but I think is true in the background is you used to think that if you got a college education, you were on track to advance. Now we know from other polling that people are much less sure about whether a college degree is a certain ladder into the middle class. And the thing that I heard that surprised me the most was multiple people talked to me about labor unions. They said things like, my father and my uncle had union pensions, and I don't. One woman said to me, my father died about 2 weeks ago, and the union gave my mother a funeral benefit to pay for funeral costs. And I was just a little surprised to hear that unions, I know they've been in the news because of these labor strikes recently in the auto workers and in Hollywood, but unions were on people's mind when I talked to people, and people were aware that there's a decline in union representation in this country.
Yeah, that's interesting to see that weighing on those people you spoke to. Aaron, so much of this is going to be looked at in the context of the upcoming presidential election going into 2024. When you tap into the sentiment of those that you polled, how much of this do they see as a gradual change, a gradual decline? How much of this do they point directly to the administration in power to say, this is the reason why we are here, or I am here where I am today?
Well, in this poll, we didn't ask, what do you think of Biden and what do you think of Trump? We asked what people's political leanings were, but we tried to insulate this economic question from politics, which is impossible to do, because whenever we asked, what do you think about the economy, a lot of people answer, here's what I think about the president, and views of who's running the country kind of skew the economic data. So I don't know who were Trump voters and who were Biden voters, but I can tell you that Republicans, for instance, were much more likely to believe in the American dream and think that it still holds, but also to believe that life had gotten worse over the last 50 years. So they kind of believe in the ideal, but think that it has faded. Democrats were more likely to think that the American dream doesn't hold true right now. But the biggest differences in this poll were not by political party, and that's what interested me. One of the biggest differences was by gender. Men were much more likely than women to believe that the American dream is alive. And I'm interested in that. I think gender is fascinating because in the data that I've looked at, until the pandemic, there were pretty big gender differences in how men and women viewed the economy. Women, until the pandemic, were much more likely to feel fragility in the economy more than men. Men were more likely to say, I think I'm going to get a raise this year. I think I'm going to have a comfortable retirement. I think the economy is in good shape. And women were much less likely to say that and more worried about getting a raise or economic advancement. And I think that's because even though we've had a lot of changes in gender roles, women still, have a more fragile role in the economy. And here, too, men were more likely to believe in the American dream than women. And young people were much more pessimistic about the American dream than older people. And those differences were bigger than by political party.
So for the women, I understand. I mean, you have a wider pay gap, though it did make some gains during the pandemic. But what about young people? Some of these people who haven't lived through some of the worst economic recessions. Why so much pessimism there?
That's a great question. And again, some of this is reflecting views of the economy. And some of this is what a colleague of mine, Greg Yip, our economic columnist here, calls refer to pain. There's a lot going on in this country to be unhappy about, and people might be reflecting some non-economic views when we ask about the American dream. I mean, democracy right now seems fragile. We're all in this political mode where, oh my God, we've got a year to live through this presidential election, and we assume that the two nominees are people who we already know everything about and we don't like very much, and we have to live through this for the next year. There's just a lot of general unhappiness, even though, I mean, there are many economic indicators that are very strong. And that's one of the puzzles here. And as we talk about sentiment, is why are people feeling so crummy, both about the immediate short-term economy and these longer-term structural changes, when there's plenty of data that you can find about this being a much better economy than in past years, and very good right now as well.
Certainly that facts versus feelings narrative continuing to play out in that messaging from the Biden administration as well. Appreciate you taking the time to join us this morning. Aaron Zitner, Wall Street Journal reporter. Thank you so much.
Good to be with you.
Well, the 2023 United Nations Climate Change Conference kicks off later this week. But with few countries willing to sacrifice in order to limit climate change, what positive result can really come out of this meeting? Well, it seems that the only beacon of hope to combat climate change is coming from the explosion of clean energy to cut down the use of fossil fuels. Now, the growth of solar and wind power were fueled by subsidies, technological advancement, and large-scale manufacturing, making them cheap. And electric vehicle batteries have also become cheaper. Along with solar, wind, and EV batteries, the cost of energy storage technologies also dropping. So with all of these new, cheaper power options, actual coal generation is down compared to previous forecasts. Venture capital has taken note of this shift to clean energy, and funding for carbon and emissions tech has grown every quarter since 2017. Now, if investors could get behind clean energy, is that enough to combat climate change, or do we still need countries and businesses to sacrifice for the sake of the planet? I mean, as we look at this, we look at some of these things really beating forecasts here. But when you look at some of these clean energy stocks, they've been really beaten up year to date. I believe only First Solar is one of the few clean energy stocks not beaten up. Others like Enphase down more than 60% year to date, AES down 40%, Sunrun, SolarEdge both down 53% and 73%. I wonder what the disconnect is between the optimism and how investors are actually feeling about this clean energy, Akiko.
Yeah, I'm not sure there's necessarily a disconnect, because when you think about where the performance has been, there's been a lot of concern about the higher rates coming through. The IEA has warned about this as well, that when you think about these upcoming projects, and to be clear, that last question you posed, Rochelle, the reality is there's got to be a lot more investment. So that's putting it mildly, to get to that ultimate climate goal. But the IEA has warned that with these higher rates, this is a very capital intensive industry, and that's going to start to bite, because the costs are going to be a lot more expensive, especially when you look at emerging economies as well as developing economies that are really looking to accelerate some of these investments. But climate financing sure to be a key topic going into COP28, and certainly something we're going to be keeping a close watch on over the next few weeks out in Dubai. Well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Bitcoin prices are falling this morning. The cryptocurrency briefly touched an 18-month high last week, bouncing back from a sell-off after the CEO of crypto exchange Binance pled guilty to money laundering charges. Our next guest says even with the negative Binance news, it's, quote, inevitable the cryptocurrency will rally above $40,000 by year end. Joining us now is Marcus Thielen, DeFiResearch.com head of research and author of Crypto Titans. Thank you for joining us this morning. So give us some context here, because we do tend to see Bitcoin rallying at year end. How much of that then is tied to perhaps Bitcoin shrugging off some of these Binance concerns versus sort of this seasonality?
Yeah, thanks for having me. I think the market took the Binance news, quite well. I think the market has been waiting for this news for, at least a year, we can argue. And I think the rumor was that Binance would have to pay, 10 billion. We heard some other news that, they tried to negotiate for 8 billion and 6 billion, and finally they settled with the DOJ, for 4 billion. And of course, 4 billion sounds a lot better than 10 billion. So I think the market took it for that reason as pretty good news.
So is this finally removing that overhang? I mean, you heard Brian Armstrong from Coinbase say that the industry can finally turn the page as a result of what's played out with Binance, among many other issues. Is it as simple as that?
Well, it's not as simple as that, because we still have the SEC outstanding with kind of 13 potential penalties. So the SEC was not part of this deal. That's certainly like an overhang, but nevertheless, I think the industry looks through it, and the industry has gone through various crypto exchanges, really from from Mt. Gox to Bitfinex to BitMEX to FTX and so on. So it's not going to be a big headwind. I think really the tailwind that we're going through, as we mentioned this briefly earlier, is December tends to be a positive month, so average returns for December tend to be plus 12%. Q1 seems to be a little bit more struggling. But of course, we're having these macro tailwinds of when the Fed stops or pauses interest rate hikes, that Bitcoin tends to rally. We have seen this in January to July 2019, after we had successive rate hikes in 2018, and then Bitcoin rallied over 6-7 months by like 300%. Of course, we're not projecting a 300% rally, but nevertheless, when the Fed pauses after an extensive rate hiking cycle, Bitcoin tends to rally. And of course, the other comparison here is also when the CME future were announced that they're going to be launched in, they're launched in December 2017, but we got the green light on October 31st. So during this kind of 2 months window, Bitcoin prices rallied 182%. So from the moment the SEC might approve a US Bitcoin ETF based on the spot Bitcoin, we might actually see an extensive rally then, and that's what makes us quite bullish into next year.
Now, Marcus, this isn't the first time that we've been waiting for this, a big catalyst for Bitcoin. And as you talk about the spot Bitcoin ETF, other countries that have launched it didn't see a massive rally. Why will this time be different?
Well, the US is, of course, the largest pool of capital. And of course, ETFs are only really established in the US. We have seen this a long time, in Asia, how Asia tried to establish ETFs, but people don't really use them. And I think this is because the investor base is very different for the US market than anywhere else. And the US is really dominated by a lot of institutions, and those institutions are using ETFs really in their asset allocation. Of course, we have the registered investment advisor community, and estimates vary from, they manage 5 trillion to even more. But if they move like 1% of those 5 trillion, that's like 50 billion into Bitcoin, right? And I think that could have like a big impact, because we sort of can calculate if the market cap changes, what might be the implications for the price of Bitcoin. And what has really changed is really that we have, certain judges telling the SEC around the grayscale lawsuit to go back and reevaluate their estimates. We're having BlackRock as the largest asset manager in the world, also filing for a Bitcoin ETF. So I think the pressure is really building. And then there is an overall sentiment that the market had that the US regulatory regime is trying to clean up the market. So and the last missing piece in this puzzle was, for example, to sort of like eliminate an exchange from the US market that has been known and admitted to had illicit trading going on.
Marcus, you said even if one of these spot Bitcoin ETFs move, that could have a big impact. We're looking at Bitcoin roughly at $37,000 right now. What does that move look like? How much higher can it go?
Yeah, I think we have heard a false rumor, that proved not true, where Bitcoin rallied 10%, literally in a heartbeat. So we would estimate if a spot Bitcoin ETF would be approved, Bitcoin could go up easily 20%. And I think, to put it in numbers, there's around $120 billion US in precious metals ETFs in the US. So that means in gold and in silver. And if you just move, 10, 20% of those, shift them over into Bitcoin, you have certainly sort of something around in the range of like $25 billion of inflow. And we calculated this might have actually an impact of every $1 billion, a 4% impact on the price. So we might actually see kind of a price towards kind of 57,000. We calculated. We can see if there's an approval for the Bitcoin ETF.
57,000. In the medium term?
In the medium term, yes. I mean, it sounds reasonable, right? When you look at, we were just at 25,000, like 2 months ago, and now we're at 37,000. So this is just literally like, sort of like 12,000 rally that we had. So another 12,000 point rally, it gets us already like to the 50,000 point area. So I think this can easily happen. And again, as I said, if you put in kind of the macro tailwinds of the Fed pausing, if you compare to the 2017 episode when the CME announced the Bitcoin futures, I think there is just a lot of tailwind, and I think there's a lot of pent-up demand. And don't forget, we have all these ETF providers. They're of course doing a lot of marketing. There are a lot of educational, and Larry Fink, as the CEO from BlackRock, is almost every other day on TV and saying how important a Bitcoin ETF is. So I think there is a coordinated marketing effort now to really bring prices higher.
And Marcus, just quickly, I want to talk about the domino effect of the repricing of bond yields, because you're saying that, in particular, second-tier tech stocks that correlate with second-tier altcoins and crypto should see a benefit there. What are some of the top picks in that space?
Well, of course, people comparing right now, the second-tier altcoins, let's say the Solanas of the world, might be kind of the Ethereum of this cycle. So I think we're seeing a lot that the revenues are actually increasing, and there was a big shift since literally a month ago. And a month ago, what really happened? It's becoming inevitable that we're going to get this ETF now. And I think once we had this false rumor, we had like some other issues as well. We had about Ripple lawsuits for the executives were like thrown out. Out of the lawsuit that they had. So in the end, I think there is just like a lot of second order effects, because tech stocks and crypto are long duration assets, and if we see lower interest rates, lower bond yields, this is what benefits both. And I think we can look back kind of the last 3-4 years where we had the rally up and of course the crash down when we had the move in the bond yields. And I think based on our calculations, we're going to see a lot lower inflation next year. Our model from last year indicated we're going to be around 3% by now, and we sort of are at 3%. And actually for next year, we're predicting 1.6%. And this is based on the model we have been using, for a long time. So we are really bullish here right now. And I think, this is really just a summary of all these calls that we had for this year.
Marcus, you're giving a lot of hope to people who hung on to their crypto assets through the crash. Marcus Thielen, DeFiResearch.com, head of research. Good to talk to you today. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
8 years after the Hunger Games' last release, its new installment of The Ballad of Songbirds and Snakes took the top spot at the Thanksgiving box office this year. With us now is Yahoo Finance's Alexandra Canal. So, Ali, how did this weekend stack up to past years?
Well, we did see an improvement. The overall 5-day box office weekend expected to pull in $172 million. That's the current estimate, and it's better than what we saw last year and the year before. Last year, we saw $123 million, 2021, $143 million, but we're still severely lagging what we saw pre-pandemic. I mean, 2019, the box office raked in over $263 million. 2018 was the biggest Thanksgiving box office weekend of all time with more than $315 million. And consistently, we used to see this weekend pull in $250 million or more. And we just haven't seen that since 2019. Now, there's been a lot of challenges, obviously, with COVID production delays. And then this year, we had the double Hollywood strike that caused the delay of certain films like the Dune sequel, for example. That would have added a lot to the Thanksgiving box office. It would have just driven more momentum to this past weekend, and we just didn't see that. So perhaps, we'll see a little bit more signs of life moving forward. Obviously, we had a great summer season. I mean, the prequel doing very well, securing $42 million, followed by Napoleon, $32.5 million. That was a surprise from Apple and Sony. Apple really trying to shore up their film division there as well. So perhaps, this is a good encouraging sign moving forward.
Indeed.
Ali, we're showing Wish on the screen there. You were talking about this on Friday. A disappointing debut for Disney. How did the rest of the weekend go?
Yeah, not too well, Akiko. $31.7 million. The estimate there was between $40 and $50 million. So once again, we saw Disney severely underperform at the box office. We know CEO Bob Iger, he has been determined to revamp this film division. The company has been struggling with their Marvel franchises, their Star Wars franchises, and animation used to be the crown jewel for Disney, but they faced some fresh competition with companies like Sony and NBC Universal really coming up strong with their own animated films. So, this is something that, again, is a big priority for CEO Bob Iger. We'll see if they can pull it off. But for now, this is just another sign of Disney's film struggles. And Wall Street analysts that I've spoken with have said, they need to program more sequels, more films that they know are going to deliver. We know that there's a Frozen 3 coming, a Frozen 4. Maybe that'll be over Thanksgiving in the next couple of years.
Okay, we'll be watching. Ali Canal staying on top of that for us. Thanks so much. Well, an agreement has been reached to extend the truce between Israel and Hamas by an additional 2 days. That's according to Qatar's Ministry of Foreign Affairs. The ceasefire began on Friday. Over the first 3 days, Hamas freed a total of 58 hostages and Israel released 117 Palestinians. The ceasefire has been predicated on the release of hostages while also allowing for humanitarian aid to flow to Gaza. Hamas's attacks on October 7th killed 1,200 people, and the White House making very clear over the weekend that they have really been at the heart of these discussions for the hostage releases. Rochelle.
Indeed. Well, that does it for now. I'm Rochelle Akufa with Akiko Fujita. Thanks for watching. We're back with you tomorrow.